Commissioner Michaud, can you hear me? You've got some sunlight. You've got some sunlight hitting your face, and it makes you look very weird.
That will pass too soon.
Okay.
I'm going back on mute.
Okay.
All right, Mr. Chairman, we are live and recording.
All right. Good morning, everyone. I'm Bob Hunter, Chairman of the North Carolina Property Tax Commission, and welcome to this April 21st session. Let me introduce our commissioners, Vice Chairman Terry Wheeler, and Commissioner Alex Guest, Commissioner June Michaud, and we're missing today Commissioner Bill Peasley, who will not be sitting today. Also, we have Mr. Steve Pelfrey, our General Counsel and Secretary, and Ms. Linda Garrett, our stenographer, and Ms. Alexander Bendette, our host and able staff member for the commission. Let me read something that I'm supposed to read before every session. In accordance with the State Government's Ethics Act, it is the duty of every commission member to avoid both conflicts of interest and appearances of conflict. Does any commission member have any known conflict of interest or appearance of conflict with respect to any matters coming before the commission today? If so, please identify the conflict or appearance of conflict and refrain from any undue participation in the matter involved. Seeing no commissioners expressing a conflict or appearance of conflict, that duty is taken care of. Today, we originally had probably about 7 or 8 cases scheduled today, and we thought until yesterday we had 2 for hearing today. All the others have now settled, continued, or withdrawn. Excuse me. And so today we have 1 case, American Homes for Rent Properties 1 LLC, which is 20 Property Tax Commission 0102. And then we have an administrative matter today with no AV 14 or no AV 63. Sunrise Hotel LLC 21 Property Tax Commission 0071, which we'll deal with after we finish this matter. So the first matter we have before us today is the appeal of American Homes for Rent Properties 1 LLC, and we have a pre-trial order. It looks like all the exhibits are stipulated to, and it looks like there are 3 or 4 possible witnesses for each of the parties. I assume there are no remaining issues then to be dealt with before we get into the hearing, Mr. Shaheen.
No, sir, Mr. Chairman. We are very grateful to the county. We think we've got a very interesting case for you today, and look forward to having it before you.
Okay, Mr. Adden, anything that needs to be dealt with before we start?
No, Your Honor.
Okay. Mr. Shaheen, we'll hear you briefly just to give us an idea of what this case is about.
Yes, sir. First off, thank you, Mr. Chairman, and other members of the commission for your service. My name is Larry Shaheen. I'm an attorney at the McIntosh Law Firm representing American Homes for Rent. We are before you today on what I believe is a matter of first impression, and I don't get to do that often, so I am very excited. But first, before we get started, I want to thank Ken Joyner, Jeremy Blackwelder, Calvin Johnson, and the whole team at Mecklenburg County, primarily because I was involved in what happened in 2011, and they have done a wonderful job making sure that assessor's office is top notch. We are not here today to bring any negative allegations or discussions against that team. In fact, I believe that team is probably one of the best in the state. We are here today to discuss what I believe to be a matter of law and something that is novel and new here in North Carolina. As many of you are aware, residential rental home ownership is growing in North Carolina and is oftentimes in many zip codes becoming the majority of ownership in some zip codes, specifically here in Mecklenburg County. Large portfolios of residential rental homes provide affordable housing and are able to keep in existence naturally occurring affordable housing. And because of that, these properties are commercial activity. Now, Mr. Adden, myself, and Mr. Joyner have a natural disagreement about which methodology should be used to value these homes primarily. We do not discount that the sales approach should be considered. However, given that residential rental homes in the amount that folks like American Homes for Rent and other homeowners in this state have now started to use, we believe it is vital, and it is actually a matter of law that is governed not just under the case law, but by North Carolina Department of Revenue's own regulations for appeals, that the income stream should be what these individuals are taxed on. Now, by agreement, Mr. Adden and I today chose to hear only this one case because it involved two properties. We did not want the commission to have to sit through 8 hours of testimony on the 114 properties that we brought before you based on the income approach. We felt it would be better for you all to rule on these two based on what we're going to bring before you today. And then based on that guidance, I will either dismiss my appeals or Mr. Adden and I will come to a settlement. But the goal here was to be able to allow the commission to hear this new issue of law, help us with guidance, and then be able to move forward. The facts are this: the portfolios of these residential rental homes are growing. We have facts that we will present today that will show that North Carolina has already made provisions for these homes as commercial properties. We believe that due to the disparate nature of sophistication, that homeowners who purchase for home ownership, who are not in the business of renting property, and commercial property owners who are very sophisticated should not be treated the same. And the reason for that is because North Carolina has a very long precedent of treating commercial property owners differently than homeowners. And the goal for this will be to allow for North Carolina to continue to use the sales approach as a methodology, but primarily use the income approach to value these residential rental homes. We will be presenting case law and regulations today that show this. You will also hear from American Homes for Rent about their business practices and how they value their properties. You will hear about the growth in their industry, the success and failure using the income approach across other counties, and you will also see their income approach, which will show a significant difference in value. You will also hear from our expert appraiser, who will tell you that the standard methodology in the industry for these residential rental homes is the income approach, and that the method used by my client in preparing their income approach was proper. You will also hear from that expert that reliance on the one methodology is not a proper analysis. Furthermore, as we are before you on an issue of law as well as an issue of fact, we believe the law clearly states that as the burden shifts to the assessor upon presentment of evidence of a difference in value, that Mecklenburg County will attempt to meet its burden today and will do so using the sales approach. And we will stipulate that it is very well developed, exceptionally well developed. However, they did not prepare an income approach. And because of that, there lies the crux of this case today. Mecklenburg County's lack of an income approach model for these properties means that their reliance on the sales approach only is an arbitrary reliance on that one methodology over the industry standard of an income approach. And that resulted in a value significantly higher than that at which it should be valued based on the income stream. We look forward to the presentation today and of course are grateful for the opportunity.
All right. Thank you, Mr. Sheehan. I've got a question, but I'll save it till after I hear from Mr. Adden. He may answer it. Mr. Adden?
Thank you. This case involves two single-family residential homes. Parcel number 165-073-37 is a single-family residence located at 6110 Goldworthy Court in Charlotte. Parcel number 029-192-58 is a single-family residence located at 3319 Cabello Court in Charlotte. The county assessed the value of the Goldworthy Court parcel at $167,500. The taxpayer contends that the value should be $132,700. The county assessed the value of 3319 Cavello Court at $205,000. The taxpayer contends the value of the Cavello Court property should be $168,100. The county, when it does its review, you'll hear from Mr. Joyner, who will explain the county's revaluation process and how the county revalues single-family residential homes. It treats all single-family residential homes alike, whether they are owned by a homeowner, whether they're owned by a corporate entity that rents them out, or whether they're owned by Michael Jordan. Ownership does not dictate the value of a property. Use of the property, which the use of these properties is single-family residential homes. The persons living in those homes receive the same services as other homeowners in the county: garbage, police, fire, schools, governmental services. And we do not believe that the ownership of a property should dictate how it is valued. The county considers all three approaches to value when it values its home, when it values all properties in the county: income, sales, and cost. For single-family residential homes, and we have over 250,000 single-family residential homes in Mecklenburg County. When we primarily rely on the sales comparison approach. These particular cases, these particular homes, the county has very good sales data to support the values. In order for the taxpayer to succeed in this case, the taxpayer has to show that the county's assessed values substantially exceed true value. True value of these homes is right around where the county has assessed them. Thank you.
Okay, let me ask this question. It looks like the issue is whether or not should use the income method. Is there agreement, Mr. Sheehan, Mr. Shaneen, that the county's sales approach is reasonable, such that we don't have to get into the real nitty-gritty of everything involving the sales approach? It seemed like that's what you were indicating.
Sir, I am more than happy to stipulate that. More than happy. This is not an issue with their approach. In fact, I think their approach was expertly put together, as you can see from the evidence. No, I do not believe that to be an issue today, sir.
Okay, and then Mr. Adden, let me flip that question. What about their income approach? Have you examined it? And if the income approach was to be used as the method or one of the methods, is the result of that income approach reasonable, or do we have to focus on the amount of that income approach?
We do not agree on their income approach. Several reasons.
Okay. All right. Well, we've got a stipulation as to the sales approach, but not as to the income approach. And so at this time, then, Mr. Shaheen, we'll let you call your first witness.
Thank you very much, Mr. Chairman. American Homes for Rent calls as their first witness Mr. Bradley Wood, Senior Vice President of Acquisitions and Dispositions at American Homes for Rent.
Okay.
If I may.
Sure.
Good morning, Mr. Wood.
Good morning.
If you would please describe for the commission your role and position at American Homes for Rent.
Mr. Oh, there you are. Okay, I got you. Go ahead. I still see you.
Can you hear me?
Screens, and I thought we'd gone to a blank one on you, but I see you. Just shifted positions. Go ahead, Mr. Wood.
Okay. All right. So I oversee national acquisition activity for our portfolio. So we build homes. That falls under a different line, but we also buy homes. And when we buy homes, we have a team of analysts that review currently available inventory as well as off-market deals. And in times past, we would also purchase properties via the trustee sales or foreclosure auctions. Sometimes we'll also purchase properties through portfolio sales as well. But I oversee that national acquisition strategy and also oversee how we model and view and value these properties.
All right. Mr. Wood, can you please take the commission through your evaluation methodology? And I know we've got Exhibit 10, which is a little bit clunky just because it's a long Excel spreadsheet, but wanted to just have you describe for the commission what your review process for a property looks like and your focus on the income stream.
Sure. Aside from a few qualitative metrics that we apply, we're looking for a generally standardized type of home. The quantitative metrics that we look for are laid out in that exhibit. But if you think of an income statement, cash flow analysis, we start with developing and understanding the revenue a property will generate. So we'll start with rents, and we'll work our way down to the bottom line. So we'll work through all of the different expenses that pertain to that property: maintenance expenses, bad debt, vacancy, property taxes, and we'll eventually solve for what we call a cap rate. So a property for a $100,000 property, just to make it simple, if it generates $5,000 a year in revenue or in cash flow, that property would be a 5% cap rate property. And so we'll have different targets in our different markets for cap rates that we'll try to purchase properties at. What it usually does is limit our purchase price or purchasing power in those markets to where oftentimes we're buying properties at a discount. But that usually comes due to the fact that we're buying properties that need work or need a little bit of rehab. And we have construction teams and local vendors that we put to work and have renovate and update these properties to get them performing the way that they should.
And Mr. Wood, how often would you say, when you do your analysis of properties, that the purchase price for a residential homeowner, that price is inflated beyond what your analysis shows?
Yes, in most situations. In most situations, our purchasing power is less than what a normal owner occupant would be able to would be offering. Case in point, for every 5 to 7 offers we send out, which are limited by cash flows, we might only purchase one of those properties.
Mm-hmm. And how often would you say, when you sell a property, does American Homes for Rent take a profit or a loss on the sale of those properties?
It depends. We try not to take a loss. But in certain situations, due to appreciation and others, we will make a profit. But that's not our normal business operating. That's not our normal model. Mm-hmm. Because we're registered as a real estate investment trust, we generate most of our income, the vast majority of our income, from the revenue streams of rent. And so we will only sell homes in certain situations, such as sometimes HOAs enact restrictions on our ability to lease properties in a neighborhood. So we will have to sell the homes in that neighborhood. Sometimes we will take a loss. Sometimes if we bought 5 or 7 years ago, we'll make a small profit. But that is, the sales of our homes is not a major strategy for us or a major means of generating revenue.
So just to make sure we draw that one statement out, your major source of revenue is income from rentals, correct? Not sales.
Correct.
Okay. And then I guess, Mr. Wood, the last question I'm going to have for you is, when you're analyzing properties in an area and you're looking at the market, are you primarily looking at what those homes are selling for, or are you looking at what you're able to get those homes at from a rental rate perspective?
Yeah, the latter. Primarily, we're looking at what those homes will be able to generate for us. We work for our investors, and thus they expect a certain return on their investment, and so that return on their investment is dictated by the rents, not the market values of the property, or the cost value, cost basis of those properties.
Understood. Thank you very much, Mr. Wood. Mr. Chairman, at this time, we have no more questions.
All right, Mr. Adden of Mr. Wood, Ross.
Yeah, on that last point. So, Mr. Wood, when you look at acquiring property, you're looking at the rental rates that you think you can get, and you are not taking into account what the true market value of the house is, correct?
No, we mostly generate our purchase price based on the rental revenue and that cap rate, but we do also look at the market value. So.
You're breaking up there.
Hold on, Mr. Wood got muted somehow. If you'll repeat that, Mr. Wood.
Sure, sorry about that. In most situations, we are limited by cap rate. We're not able to, if a property on the open market purchased by owner occupants is worth $100,000, we might only be able to offer $90,000. In few situations, we're most often limited by income. In some situations, maybe we're able to offer $110,000. The rents are very strong in a neighborhood, but we will cap our purchase price or limit it based on market value. But in most situations, we're limited by income.
So in most situations, you're not concerned about what the true value of the property is on the open market.
In most situations, I would say it's not as big of a factor, but we are concerned about it, but it's not the driving factor in the pricing of the deal.
Now, and you said that you're limited by cap rate, and cap rate is based on what your investors want out of the properties?
Yes, and our general targets for that market or that area, yes.
When you say your general target, you're talking about a cap rate for America Homes for Rent, correct?
Correct.
And now on your exhibit 10, on page 4, you have a required yield of 5%. Do you see that?
Yes.
That would be your cap rate?
Correct.
Okay. Now, do you have exhibit 5 in front of you?
Yes, sir.
That's your income evaluation for the 6110 Goldworthy Court.
Yes, sir.
Now, your exhibit 5 has a cap rate of 7%, and it's loaded for taxes for 1.31%. You see that?
Yes, I do.
Now, it has, your exhibit 5 has a net operating income of $11,030.78. If you go back to exhibit 10 and apply a 5% cap rate with a 1.31% load for taxes, you would get a cap of 6.31%. You agree with that?
Yes.
Can you do the math for us? If you have $11,030.78 NOI for Goldworthy Court and apply a 6.31% cap rate, what value do you get?
If I apply that 6.31% cap rate, you said?
Yes, to $11,030 NOI.
Sure. I get 174,817.
And the county's assessed value is $167,500, correct?
Correct.
So if you apply a 5% cap rate as you have on exhibit number 10, load it for taxes, apply it to the NOI for the Goldworthy Court parcel, you get an income value in excess of county's assessed value, correct?
Correct.
Let's do that same exercise for exhibit 6, which is the 3319 Cabela Court. The 3319 Cabela Court, you have an NOI of $13,969.80. Apply a 6.31% cap rate to that, if you would, please.
Sure. I see 221,391.
And the county's assessed value is 205, correct?
Correct.
Is it America Homes for Rent's position that corporate owners of residential homes, their value should be used in an income approach? Is it the America Homes for Rent's position that if I have a house and I decide to rent it, that the county should use the income approach for my rental house?
Yes, that's what I would recommend personally. It is more accurate for the landlord or the owner of that property, but that's my personal feeling.
Hey, you're aware that in North Carolina, we have a revaluation cycle that can be up to 8 years. We have to do it at least every 8 years. You aware of that?
Yes.
So if the income approach produces a value, if your income approach produces a value that's 20% less than what the sales approach value is, the market value is, if I am a owner of a house and I'm renting it on the revaluation date, your position is that the county should use an income approach value to value that house, correct?
Correct.
Now, if I decide a month later to move into it myself, then should the value change because I'm now owning it, I'm now occupying it myself?
Objection, Your Honor, requires him to answer a question about information past the date of revaluation.
Well, I think that's relevant. So
Okay.
Go ahead, Mr. Wood.
Sure. So because I oversee acquisitions in a number of different markets, in most markets, the revaluation period is much shorter. So I don't want to speak to the reevaluation period for Mecklenburg County specifically, but in most markets, we see that as being more accurate in valuing the taxes based on the use of that property at that time. The benefit to the county and to the residents is that we don't pass along those increased property taxes for a property that's not being used for its intended purpose or for the valued purpose of that property. So, for example, with the exhibits, exhibits 5 and 6, we either would not have purchased those properties, possibly, or the rents would have been increased on those properties so that those same cap rates would have been achieved. So it is a pass-through cost.
But
So,
your income approach value depends on what cap rate you select, correct?
yes, and I may be stepping out a little bit, but I would recommend each investor has a different cap rate, a different hurdle, and a different target based on their investors and based on their goals as a specific company. So whether they normally range anywhere from 5 to 9%. So these are a 5 or 5.5 for us is very aggressive. That actually increases our purchasing power substantially, and we get very close to the market values. In other situations where it's a 7 or an 8% cap rate, it might be discounted a little bit more, but that's from an investment standpoint, a measure of risk in a neighborhood and a measure of return expected on our investment.
Your cap rate is set by your investors, correct?
Yes, set or agreed upon by our investors or our board of directors.
Your cap rate is not a market cap rate.
Not necessarily. We will set and agree to market cap rates different from other markets.
You will on sometimes, but you just said that the investor sets the cap rate.
The investors represented by our board agree upon the cap rates for each of our markets. Sometimes we'll say we're going straight across the board. We're going out at a 6% cap rate. Other times we'll say we want to be more aggressive. Let's say when we were purchasing in California, for example, we might lower that yield all the way down to a 4.5% cap rate. So my point of all that is I would recommend that if you did approach it from an income approach, to set a benchmark somewhere in the middle to capture most of the investors. I mean, I would anticipate it being somewhere on a bell curve where most investors fall within that 6 to 7%, maybe that 7%, 7.5% range.
Let me direct you to your Exhibit 4, which is 2 pages of the Department of Revenue's Appeal Handbook. Have that in front of you?
I do.
Now on at the beginning of on page 36, number 4 says number 5 says market value versus market price. And if you flip over to page 38, and the second paragraph says market value. Will you just read that paragraph into the record? Market value is the most probable price.
Market value is the most probable price expressed in monetary terms that a property would bring if exposed for sale in the open market in an arm's length transaction between a willing seller and a willing buyer, both of whom are knowledgeable concerning all uses to which it is adapted and for which it is capable of being used. It is a hypothetical or estimated sales price.
Now you testified earlier about you do acquisitions and everything. And sometimes y'all acquire property from trustees, correct?
Correct.
And generally a trustee sale price is going to be less than a sale on the open market. Is that correct?
Correct.
Because banks are just trying to get rid of a foreclosed upon property.
Sure.
And basically you have all these models on how much America Homes for Rent is willing to pay for a particular property, correct?
Correct.
And what you're willing to pay for a particular property is not necessarily what a hypothetical reasonable buyer would pay for, willing buyer would pay for the property.
Correct.
you're basically looking for some good deals because you know that if you have some good deals, you can do a little bit of work on the houses and rent them and make a profit on the income, correct?
Correct. It becomes a more profitable transaction the better the purchase price of that property.
But my point is, just because the price that you're willing to pay does not necessarily mean the price that a willing buyer would pay on an open market.
Well, in most situations, as I mentioned earlier, in most situations where we're most competitive is when a property needs a significant amount of work. And we do a lot of work on our properties. Our average rehab that we spend on these properties right now is around $30,000. Using local contractors, local vendors, we believe we're doing a lot of good for the community when we're increasing or working on these properties. I also believe that in most of those situations, trustee sales, for example, the willing and able buyers are very few. One, because you have to close in cash, and two, because those properties generally require much more than our normal investment. So they might require $40,000 to $60,000 to clean them up and make them safe and habitable. So that would generally dictate the discounts that those properties are sold at.
Now,
and I'm just giving round numbers,
sure.
just to use an example.
Now, there on that exhibit 4, page 38, it has paragraph 7, actual data versus market data. And it says courts have also held that actual income streams are not to be the sole basis for determining market value. Now, America Homes for Rent, the only evidence that we have for America Homes for Rent's values for these subject properties is your actual income approach model data that you did, exhibits 5 and 6, correct?
I believe so, Larry.
So the sole basis that you want to determine, the basis for America Homes for Rent's $132,700 value for Goldworthy Court is your exhibit 5, in which you take actual income, actual expenses, and apply a 7% cap rate that your investor said to apply, correct?
Correct.
And for the Cabela Court property, your only evidence is exhibit 6, where you take your actual income, your actual expenses, apply again your investor's cap rate of 7% to get to your value of $168,100.
Correct.
Now, if you would, look at county exhibit number 5.
If you'd like to share your screen, Mr. Radden, I don't believe he has that exhibit.
I don't know. I'm computer illiterate, Larry, as far as sharing the screen. You don't have exhibit 5?
No, I don't.
Okay, that's fine. Just a few more questions.
Excuse me, Mr. Adden, isn't Exhibit 5 the same as his Exhibit 5?
No, my exhibit 5, county exhibit 5 is analysis of transactions. County Exhibit 5 is an analysis of some purchases at America Homes for Rent made in 2017 and how their purchase price exceeds their income approach value considerably. But if he doesn't have it in front of him, that's fine.
Well, my Exhibit 5 is showing the same as his Exhibit 5.
Commissioner Wheeler, this is Alex Guess. What is the title to your Exhibit 5 that you're looking at for the taxpayer and the title for the Exhibit 5 for the county that you're looking at?
For the taxpayer, it's taxpayer's income approach valuation does not result in true value based on related transactions.
Right, that's the county's exhibit.
Well, that's what I'm saying. They're both the same, it appears.
No, his Exhibit 5, the taxpayer's Exhibit 5 is that simple one-page income approach pro forma for the Goldworthy Court property.
Yeah, it's difficult in the taxpayers' exhibits trying to find the way they're bound. Mr. Shaheen, next time if you would put tabs.
Yes, sir.
Pick out like the county is exhibit
Yes,
2,
sir.
because it's difficult trying to find these in your exhibits.
Yes, sir.
But I understand, I think they are different, Mr. Vice
They
Chair.
are different. They are different, sir.
My Exhibit 5 for the taxpayer is page 24, which is the same page number for the county's exhibits.
This is Commissioner Guess, and I'm going to also state that my page 24, which is the taxpayer Exhibit 5, which is at the back of the packet. So the exhibits from the taxpayer were not in order. But at the rear of my packet, there is an Exhibit 5, which is titled page 24, which I will agree with Commissioner Wheeler, appears to be the same as the county Exhibit 5. In the event anyone's looking for this.
All right, Mr. Adden, do you want to refer Mr. Wood to that page and their exhibits?
Yeah, Mr. Wood, if you would, look at the end of your exhibits and see if you have that page 24, what is referred to as page 24 of County Exhibit 5.
Mr. Adden, I did not. Our exhibits don't include or should not include what the county is labeling as Exhibit 5, which is their analysis of sales.
Yeah.
That is we did not include that in our packet. It was included in the county exhibits.
Yeah.
And those are, Mr. Wood does not have that. Now I can send that to him very quickly.
No, that's fine. That's fine. I'll go on to some more questions.
Okay, apparently that, I don't know how it got in there, but the Exhibit 5 label on that one and the taxpayer's exhibit, I guess, is a copy of the Exhibit 5 from the county's exhibit. Is that right, Mr. Adden? It's a copy of that page?
It sounds like from what Commissioner Guess and Vice Chairman Wheeler said, apparently.
Yeah, and I found it also.
Mecklenburg County Exhibit 5 somehow got into the taxpayers Exhibit 5.
Yeah.
This is Commissioner Mashaw. I see the same thing as well. I have 2 Exhibit 5s in the taxpayer packet.
Okay. So apparently that got in somehow, but it's not an exhibit of the taxpayer. Is that correct, Mr. Shaheen?
Yes, Mr. Chairman, that is correct.
Okay. All right, Mr. Adden.
Okay.
Since it's in there, if Mr. Wood has it and you want to ask him about it, you can.
I don't believe Mr. Wood has it. Is that correct, Mr. Wood?
That's correct. I cannot find it.
Okay. Apparently it only got put in our exhibits and not in what Mr. Shaheen and Mr. Wood would have had, I guess. And is that correct, Mr. Shaheen?
I have a copy of his Exhibit 5 here in front of me, and we had one binder sent to us, and it's sitting here with me.
Yeah.
But I
So,
mean,
yeah.
you did not put the county's number 5 in your exhibits, did you?
No,
not?
sir, I did not. No, sir. I
It
did
must
not.
have got copied some way in the
Yeah.
file that got compiled for us. So if you need to ask him about it, Mr. Haddon, you can. If not, you can move on to your next question.
I'll just move on. Mr. Wood. If your board wanted to be more conservative with respect to a particular property, meaning they would like a higher return on their investment, is it your testimony that the county's value should then be lowered?
No. Similar to how an apartment or other income generating property would be assessed, I would expect that a general rule or a general cap rate or income approach be resolved upon, so that two apartments, right next to each other can be both assessed using the same methodology, even though they may have different investors, different criteria purchased on those properties. I would anticipate the same thing happening for our properties or other investors who own properties as rentals like we do.
But if you have two corporate entities owning rental houses side by side, your investors might have one cap rate and the other investors may have another cap rate, correct?
Correct.
And if you got on the other side of or in between those two houses, you got a house owned by a homeowner, then the poor guy that's a homeowner and is receiving the same services as the two tenants are receiving, it's garbage, fire, police, schools, he's paying a lot more taxes than the corporate taxpayers, correct? Under your theory?
Correct in certain situations. I'm also not familiar with Mecklenburg County and if there are any homeowners exemptions, but oftentimes in many of the areas we purchase in, there are homeowners exemptions, which further decrease the property taxes paid by homeowners.
But homeowners exemptions are a matter of state law that the state legislature deems certain people should be entitled to some exemptions. And there is no state law that says corporate housing entities who buy portfolios of houses are entitled to an exemption or a reduced valuation for lower taxes in North Carolina. Is that correct? There's no exemption for your client.
Correct.
Now,
that's my understanding.
And you understand that in North Carolina law, assessed value is to be the true value of a property based on a willing buyer and a willing seller, both that knowing all uses for the property. You understand that?
I do.
And the two parcels that are the subject of this proceeding are both single-family residential homes, correct?
Correct.
Now, you're not an appraiser, are you?
I'm not.
Don't have any training on USPAP or IAAO or any of those types of standards for appraising property?
No, sir.
And I want to make sure I understand this stipulation that America Homes for Rents agrees that the county's sales approach valuation for 6610 Goldworthy Court and for 3319 Cavello Court produces true value.
No.
Mr. Adden, are you through with Mr. Wood's question? And that'd be better after we get through with him, I think, if it's going to be to Mr. Shanine.
I don't have any other questions.
Okay, now you can ask Mr. Shanine and clarify that, and then he can redirect.
That's fine. That's fine. We can proceed on.
Okay. All right, Mr. Shanine, redirect.
Thank you, sir. Mr. Wood, very quickly, let's look at Exhibit 4, just very quick. Just want to draw your attention back to that. I'd like you to look at page 38 for me, please.
Okay.
I would like you to look down to the middle of the page and read for me from where it says market value and market price are identical, and then read all the way through to where it says emphasis added.
Market value and market price are identical only under the following assumptions. 1, no coercion or undue influence over buyer or seller in an attempt to force the sale or purchase. 2, well-informed buyers and sellers acting in their own best interests. 3, a reasonable time for the transaction to take place. And 4, a payment in cash or financing typical for the property type in the community. In many cases, the market price paid for property is not the market value.
And let's go back to page number 37. If you would please read just the paragraph that starts with the bullet point income approach.
Income approach. Properties which generate rental income can and often should be valued based on the present value of the income stream they generate. This approach is often used for commercial properties or for residential rental properties.
Thank you, Mr. Wood. Just a few more questions. While Mr. Adden is correct, there is not a statute that is that deals with commercial rental homeowners. It is your understanding from your experience, not as an expert now, just as a lay opinion, but it is your opinion that commercial property owners, based on this DOR manual and other experience, should be taxed on the income streams from the properties they produce, correct?
Correct.
Okay, and then one final question. Did you develop the income approaches?
Go ahead.
Did you create the income approaches that we heard about today, exhibits 5 and 6?
No.
Okay, so you cannot comment competently as to how they were created.
I can't. I looked at them generally. I didn't create them.
So your role at American Homes for Rent is not property tax analysis, merely to review acquisitions and dispositions, correct?
Correct.
Thank you. This time, no further questions.
Okay, questions from commissioners?
I have
Yes,
one
Mr. Guest.
or two follow-up questions.
Oh, excuse me, I'm sorry. Recross, Mr. Adden.
Mr. Wood, Mr. Shaheen referred you to your exhibit 4, which is begins on page 37 of the Department of Revenue Appeals Manual. We did not include exhibit the previous page, which is page 36, which is part of Mecklenburg County's exhibit number 26, I believe. And I ask you if, I guess my first question is, when America Homes for Rent tries to value properties that it's considering to buy or sell, does it use all 3 approaches to value, or does it just use the income approach?
We use 2 methods to value. Primarily, our purchase price is driven by the income approach.
Now, on page 36 of that appeals manual, you read on page 35. Page 36 says the sales comparison approach, because this approach is derived from actual market transaction, it is usually considered the best indicator of market value. Do you agree with that statement?
I don't have that in front of me, so I don't have that to look at.
Well, the Department of Revenue manual says that the sales comparison approach, and I quote, is usually considered the best indicator of market value.
I think that's been historically true, and how appraisals have been based historically, but I think that's the point we're trying to make, or we're trying to reach, is that we would like now, with rentership or institutional investors professionalizing this industry and helping it become much better, we're also looking to professionalize and refine this process too.
And does America Homes for Rent employ lobbyists to lobby Congress and state legislatures?
Your
I
Honor,
have no
objection,
idea.
witness doesn't.
Oh, he can answer if he knows. If he doesn't know, just say he doesn't know.
Yeah, I do not know.
If you want the law
We
changed
do
to treat institutional residential investors different from ordinary taxpayers, isn't that something that the state legislature should decide?
I wouldn't be able to speak to that. I probably a little outside of my my general stream.
No further questions.
All right, Mr. Guest, I believe you had a question.
Mr. Wood, thank you for your time. Couple of questions for you. The first question is, a moment ago, you mentioned that when you're analyzing a property for purchase, you use primarily two valuation methods. One is the income approach. What is the second approach that you use?
That sales CMA approach.
Okay.
So we'll. Yeah.
Okay, so you look at comparable sales. All right. When you're evaluating a property in a neighborhood or community or town, and you're looking at other properties, are you having an outside appraiser or are you doing internal appraisals on the property?
Internal appraisals.
Okay. And when you're doing your internal appraisals, are you looking for comparable sales in the neighborhood? Comparable size, comparable quality of construction, things of this nature?
Correct.
Okay. And do you use the comparable sale information to kind of maybe establish a cap, because you're realizing that some of these properties that you're purchasing need repairs? So you wouldn't want to overpay maybe on a property. And so do you look at, I have a cap, a top level, I'm going to have X dollars worth of repairs in the property, so that means I can offer a lower number?
Generally speaking, yeah, that is correct.
And do you then try to, with the repairs, do you try not to exceed the investment of the cap, the top limit?
Correct.
Okay.
We try not to exceed the after rehab market value of that property that we.
Which would be fair market value that a fully repaired, pristine property would sell to a willing buyer on the open market.
Well, we don't. The reason we were able to purchase that property in the first place is because there was either something wrong with it or work needed to be done. So by us consummating the transaction, we believe we were the one most willing to pay the highest value on that property.
Right.
I don't know if that answered the question.
You improve the property, and then if a homeowners association, in your example, were to change the regulations in that community so you could no longer rent the property, now you're forced to sell the property. I'm assuming at that point, would it be correct that you would attempt to sell it for the highest value you could obtain?
Correct.
Okay. All right. So you use a sales comparison approach and an income approach when you're looking at purchasing the properties. The sales comparison approach establishes the top level that you'd be willing to pay for a property after repairs have been made, so that you're not overstating your investment. Okay.
Yes.
Question for you. I don't know if you know this answer or not. On your financial statements for the company, do you carry the properties at cost, or do you carry the properties at fair market value with an unrealized gain or loss reported?
That would be an accounting question I don't know the answer to.
Okay. Do you know how frequently your company reevaluates their portfolio to look at the valuations of the market?
I want to say annually. I'm not sure if they go more than that, but.
Okay. And my last question for you is, if you had to sell a property, again, let's use the homeowners for example, they change the rules and you have to sell a property in a community. Are you primarily at that point, are you marketing the properties yourselves? Do you hire local realtors to market the property? How do you go about disposing of the property? Because if you're selling a single piece of property, it's not like you're bundling a group of 10 houses to sell to another investor primarily. So what's your process of selling?
Sure. So if the properties are still occupied, we do market to other investors, and they'll probably be sold based on that and valued based on that income approach. If the properties are vacant, that kind of opens up our ability to sell either to an investor or to an owner occupant who would value it based on that sales approach.
If you were purchasing a property that had a tenant in it, but maybe the tenant only had a 2, 3, 4 month period left on their lease, okay, and with no lease extensions available, and the fair market value of the property of comparable sales was higher than the income approach on this lease would generate, would you be willing to anticipate paying a little higher value if you thought you could improve the property and lease it for more money?
Would we be willing to pay more money for that property? Just to clarify, if we knew that tenant, we don't like to non-renew tenants.
I'm talking about in an acquisition.
What you're saying is if we think that the income streams of that property are going to be higher after we perform work and place a different tenant in there, yes, I guess we would be willing to value that property a little bit higher.
Thank you. That's all I have.
All right. Any other questions of Mr. Wood? Seeing none, then Mr. Shaheen.
I have another question, Your Honor.
Okay, Mr. Adden. And Mr. Adden, before I forget it, ask Mr. Jarvis or your IT person if they can set your screen so that whoever's talking, it'll focus on. We're getting such a long shot. We really can't see anything about the individual, you or who's going to be testifying, if they can do that.
Yeah, that'll be fine. We'll try that. Mr. Wood, you're aware that the commission's directive here is to determine the assessed value of the value of the property as of January 1, 2019, correct? That's our revaluation date.
Okay.
And you're aware that there were some questions from Commissioner Guess about upfitting, renovating houses after you purchase them, correct? You said about $30,000 or so?
Yeah, generally speaking, that would probably be a national average. So yes, I haven't looked at the specific numbers for Charlotte in particular.
And you're aware that the property on Goldweather Court was purchased by your client, by America Homes for Rent, in 2015. So it's been some time since it had been, since you purchased it.
Correct.
And the Covella Court property was purchased in 2016. So it's been, 2013. So it had been 5 or 6 years prior to the reval date.
Okay.
So there's not an issue here as to the condition of these two properties on January 1, 2019. They were in good shape, had tenants in them, obviously by your income pro forma, and were producing the income that your company wanted it to be produced, correct?
Yes, without looking at those properties and analyzing whether they're doing what they should be doing, I would say yes.
No further questions.
All right, Mr. Shaheen, your next witness, how long do you think you'll be with that?
Well, I don't anticipate it going further than 20 minutes, but I don't know how long Mr. Adden will cross. So,
all right, let's take a 10-minute break, and then we'll come back and do the next Next witness.
Yes, sir.
All right, I see Vice Chairman Wheeler, Commissioner Guest, Commissioner Michaud, Mr. Peasley, and not seeing Ms. Garrett. Is it on another? There you are. Yeah, there you are. Ms. Garrett, thank you. And Mr. Wood and Mr. Bosworth and Mr. Shaheen. And now we can see you better, Mr. Adden.
I'm
All
not
right.
sure that's any better, Your Honor.
Looks like you've got a little extra hair there since we.
That's
had
my
seen you
COVID
before.
hair. I have had one haircut in the past 12 months. And I don't become fully vaccinated until tomorrow.
All right, well then, maybe a haircut's in order. I'm trying to get one. I think my barber's on
You
vacation.
should get it cut online, Robert. You can raise some money that way.
Yeah.
I'm having a blank, Robert, the trial lawyer with the longer hair. Pretty
Bill
famous.
Deal.
Bill
Yeah,
Oh,
Yeah, he's trying to look like Bill Deal, I think, right?
Your Honor, that is really an insult.
Nah, it's got Mr. Shaheen laughing.
oh my God. I knew Bill. I'm sorry. God bless him.
Oh, he was a great guy. Did he
He's a
pass away?
great guy. I don't. Do you know he's in a home now?
Oh, he is?
God bless- yeah, he is. God bless him. He was a character.
Sorry to hear that. Yeah, we've lost a lot of characters in our bar, so maybe Robert's gonna start to be one. Okay,
Robert would contend I'm one, so we'll have to see.
all right. Mr. Shaheen, you can call your next witness now.
Thank you, sir. At this time, I'm going to call Mr. Eric Brown. Mr. Brown is with American Homes for Rent, and his resume is Taxpayers Exhibit 2. So I wanted to go ahead and bring that to everyone's attention. If I may?
Yes.
Thank you, Mr. Chairman. Mr. Brown, good morning.
Morning.
Thank you so much for joining us. Very quickly, if you could you please describe for the commission your education, work experience, as well as your licensure status?
Sure. First of all, good morning, everybody, Mr. Chairman, and everyone else that's joined us. I really appreciate your time in hearing this case this morning. My name is Eric Brown. I'm the Director of Property Tax at American Homes for Rent. I've been working in the property tax industry for 18 years now. I started my career at Deloitte & Touche in their property tax group, where I represented a multitude of commercial property owners, those that ranged from high-profile hotels, office buildings, retail centers, golf courses. I've worked on all different property types throughout my career. I spent 7 years in Deloitte's property tax practice, and then went to 4 years at Deloitte. I spent 7 years at my next position at Macerich, which is owner of shopping malls throughout the United States. They're also a real estate investment trust where I was a manager in our in-house property tax department there. And most recently, in my current role, I've been at American Homes for Rent for almost 6 years as the Director of Property Tax. Been with the company through a lot of growth, and been heavily involved in all facets of our property tax practice. I do have my certification in property tax. It's given by the Institute for Professionals in Taxation. They go by IPT. I'm a licensed broker here in the state that I live in, California, and that's a bit about my background.
Mr. Chairman, at this time, based on his resume and his experience, as well as his certifications, would ask for him to be qualified as an expert in property taxation valuation.
Okay, Mr. Adden, any objection?
Jack, he's not an appraiser. I don't believe he can give an opinion of value as to the subject properties if he's not an appraiser certified by the state of North Carolina.
Well, that's not what you're trying to qualify him for, is it, Mr. Shanine?
No, sir. I am trying to qualify him as an expert in how property tax how property taxation is done.
Okay, so I think he can testify as to that, Mr. Adden, including giving his opinion.
Provided that my objection is that he is not qualified to give an opinion of value of the subject properties.
Well, he can give an opinion of value, I think, is the subject property. He's just not a licensed or expert appraiser.
I would agree. In court precedent, lay individuals are allowed to give opinions of value. So yes, I would agree. Thank you, Mr. Chairman.
All right, go ahead.
All right, Mr. Brown, let's go ahead and get started. I don't necessarily feel like we need to overburden this. I'm certain Mr. Adden's going to have a lot of questions for you. Let's start immediately with exhibits 5 and 6. Did you prepare and your office prepare exhibits 5 and 6?
Correct.
Can you please take the commission through your process and how you prepared those, how you came to that cap rate, and how you were able to come to that valuation?
Sure, absolutely. I'll just kind of start from the top and walk us down through the bottom here. So starting with our gross rental income, we have access to all of our company's financial records, and we can see leases and income and expense statements that are prepared by the company. So we have access to what types of rents we're collecting for each property. We start with a gross rental income, which takes into account if a property was rented for a full year, in this case, all 365 days, what that rent would be. So in any cases where a property may have been vacant for part of the year, we would gross up the rent to have it represent a full year. And the reason we do that, of course, is because we apply a vacancy rate in the next row below to that full gross rent. In that case, the vacancy rate used here, 5.7%, was the actual vacancy rate at the time for all of our properties across Mecklenburg County. We have currently we own almost 2,600 single-family rental homes in Mecklenburg County. So we have lots of data that we can extrapolate from the overall market to select as a vacancy rate to use for our properties located there. And of course, after we deduct that vacancy rate from the gross rental income, that leaves us with an effective gross income. From there, we move on to operating expenses. We start with repairs and maintenance and utilities. Again, because of how the vast volume of properties that we own in this market, we can see what the average repairs and maintenance cost is for us to spend on a home in that market, and that's what was applied here to the repairs and maintenance and utilities number. In this case, this particular case, for the property on Exhibit 5, 6110 Goldworthy Court, that property has an HOA expense as well. Not all of our properties are located in HOAs, but in the event that they are, we use that. We take that expense as something that we have to pay. Moving down the line, management fees, which in this case were 7.5% of effective gross income. That's an internal number that is derived from our whole portfolio of operations. So this is not just a Mecklenburg County rate, but as an institutional owner of rental homes across the entire United States, we're a very efficient operator. We have investors who hold us accountable to generating certain returns and being a certain type of quality operator. And so our different management fees are kind of bundled up into a percentage of effective gross income, and that's the figure that was applied here at the 7.5%. Insurance, every property has an insurance expense. In that case, in this case, it was $99.36 that was applied for this property. And then lastly, replacement for reserves. This was also a company standard for the Mecklenburg market that was applied. We know that through the regular course of owning property, there's going to be unforeseen circumstances that come up through a repair standpoint, and we take a reserve for that anticipated cost. So that's what was applied for this replacement for reserves. After taking into account all operating expenses, those get deducted from the effective gross income to arrive at a net operating income. In this case, it was $11,031. From there, a cap rate was selected of 7%. That was taken from speaking with our acquisitions department. Each year, I get a range from that department for selective markets of the desired returns that are needed and what we're purchasing properties at in that given year. This 7% cap rate was within that range, so that's what was selected for this income approach. And then you'll notice since property taxes were not taken as an expense in the operating expense category, the tax rate gets loaded to the cap rate, and that's standard appraisal practice for what we would call a gross lease, which in the case of this type of property, the landlord is responsible for paying the property taxes, not the tenant. So that's why the tax rate gets loaded into the cap rate instead of taken as an expense in the expenses above. So bringing it all together, the overall cap rate in this case was 8.31%. You apply that to the net operating income, and we come up with a rounded value for this particular home of $132,700.
And then very quickly, can you, without having to belabor the point, very quickly move to Exhibit 6 and kind of give us what that market value versus that income approach was?
Yeah, so it's really the exact same approach that I just walked us through. The only differences here were because, of course, it's a different property. It had different rental income. All of our properties are unique in that way, depending on location and quality. They may generate different types of rent levels, but everything else that I just walked us through is exactly the same. The same vacancy rate, the same management fee expense, same cap rate. So the rest of the process is identical.
Now, can you please elaborate for the commission on how you developed that 7% cap rate?
Yeah, again, I spoke with our acquisitions department. It wasn't Mr. Wood, who we just heard from, but a different individual in his group. And they provide me, upon request, a range of cap rates at that particular point in time for different markets. And this cap rate of 7% was within the provided range.
So this is a market rate, correct?
Yeah, it was a market rate specific to the Charlotte market.
Excellent. All right, shifting gears now to property taxation as a whole. In your experience as an expert on property taxation across the country, more often than not in commercial activity, what is the general approach for commercial activities taxation and in property tax, and why is that approach the one that is used?
Well, it's unquestionably the income approach to value, and the reason for that is because all income-producing properties, that's just it's how an investor looks at buying and selling these types of assets. And so, anytime you have an income-producing asset, any investor is going to the first thing they're going to do is look at what type of net operating income that particular property generates and their decision to what they're going to pay for the property.
Now, in this specific instance with Mecklenburg County, I know you remember working with me on submitting to the county and to the Board of Equalization and Review. Can you please tell me, in our experience, did you ever encounter from the county any information on cap rate, market rent, any type of analysis from the county as to what, if they were to derive an income approach, what that would be?
No, I haven't.
Okay. And also furthermore, across the country, when we have these conversations and when you have these conversations, when individual authorities request, you use a blended approach, correct?
Yes, we look at different approaches to value, but again, paramount to all of them, we believe, is the income approach.
Okay. So American Homes for Rent would not have a problem using a blended approach so long as the income approach is the primary method by which the valuation should be obtained.
Yeah, that's correct.
And why is that?
Well, again, I mean, there are three generally accepted approaches to value, and we wholeheartedly agree that that all three approaches, when applicable, should be looked at. But again, for reasons just mentioned, for income producing properties such as our single family rental portfolio, I really feel there's no better approach to use than the income approach.
Thank you. Mr. Chairman, no more further questions.
Okay, Mr. Adden, Cross. Oh, excuse me, Vice Chairman Wheeler has a question.
Mr. Brown, I guess it's your position. Mr. Adden earlier used an example of two houses next to each other. One rents and one the owner lives in. Is it your position one should be valued using the income approach and one should be valued using the cost sales approach?
It's my position that whenever income information is available and known, that information should be considered and used. So I understand that on potentially a neighboring home not being an investment property where that income and expense information isn't available, I could see where that may present a challenge in valuing the home in that manner. But certainly on all of our properties, they are single family rental homes. We do have an abundance of income and expense data for them, and for that reason, it should be used.
Ask my question again. You got two sitting side by side, exactly alike. Should the one that is owned by the owner be valued higher than the one that's owned by the renter?
I think they should be valued in a manner in which the market supports.
Well, is that telling me that one should be valued higher than the other?
Not necessarily.
What would change it?
I guess I struggle a bit to answer the question. I think the assessor should look at all available information in valuing those properties, and
if one is valued on the sales approach and one is valued on the income approach, would that, in your mind, create inequity?
No,
Mr. Sheehan,
no.
Hold on a minute.
Mhm.
Let me handle it, Terry. Mr. Sheehan?
Yes,
the
sir.
way we have this set up, and in your dark suit, please don't express.
I'm so sorry.
yourself.
Yes, sir, absolutely. I apologize. I didn't even
I
realize
don't know where the witness is looking at you or not, but we
Yes.
see you, and so.
I won't do that. Yes, sir.
corrected you a
My
minute
apologies.
ago.
My
Thank you,
apologies.
Mr.
I didn't even know.
Thank you,
All
Mr.
right.
Chairman.
Go ahead, Vice Chairman Wheeler.
Would using the sales approach on the neighboring property and the income approach as you're proposing, would it create inequity?
I don't believe it would. I think looking at all available information in the market, if it's done appropriately, should result in similar values.
Should those values be equal?
No.
If they're exactly alike?
I'm sorry. Can you maybe rephrase your question?
I don't want to rephrase it.
Ask it again, Vice Chairman.
If they're both exactly alike, should they be valued equally?
They could be different. They could be different. And
I didn't use an
reason,
example. I didn't use an example of anything different about them. My example is they're exactly the same.
I believe if on one home you're using a sales comparison approach to value the property, and on another home you're looking at an income approach to value the property, you could end up with different values.
All right, thank you.
All right, I think now Mr. Adden. Ross,
Thank you, yeah.
Mr. Brown.
Now, you talked earlier about the blended approach, but your value for, looking at Exhibit 5, your value for 6110 Goldworthy Court is $132,700. And that is based solely on this little income pro forma, correct?
Correct.
That you did not consider any sales comps in getting to that $132,700 value, did you?
The sales comps would be a different approach.
And you did not use that approach in coming up with your value that you're asking the commission to adopt for Goldworthy Court property.
Correct. In this case, we prepared an income approach to value.
And you only used that one. You did not use a blended approach, is my point.
Right.
And the same thing's true for 3319 Cabello Court. You only used the income approach, not any blended approach.
Correct.
And the cap rate, you said you got from Mr. Wood, but Mr. Wood's testimony was not that the cap rates were a market.
Your Honor, that the witness did not say that.
Well, let him finish his question.
Okay.
Your testimony was that you got the cap rate from Mr. Wood's department, the acquisitions department. And Mr. Wood did not testify that the cap rates were a market cap rate. He testified that the cap rates were investor driven. Do you recall that testimony?
Yes.
Pardon me?
Yes, I recall.
And so your 7% cap rate that you used here is an investor driven cap rate that acquisitions department gave to you. Correct?
That's correct.
Now the gross income figures that you use, looking at Exhibit 5, you have a gross income of $15,360. Is that a gross income for 365 days of rental, or is that just the gross rental income for this property and you're not sure if it was 365 or something less?
No, I'm certain that was for a full year, 365 days.
This property was fully rented the entire year of 2018.
If it wasn't, then we would have grossed up the rent to reflect 365 days.
Okay. Now, you're not an appraiser, correct?
Correct.
And you're not certified for appraisal in North Carolina.
Correct.
And you're not giving any opinion or value of the subject properties based on the income, sales, and cost approaches, correct?
I'm giving an opinion of value on the income approach.
And your income approach does not correlate to what the value would be based on a sales approach value, correct?
Correct.
And if you change the cap rate, as Mr. Wood did when I asked him in the exercise, from 7% down to 5%, your actual income approach actually exceeds the county's values, correct?
That's true, although the 5% was taken from a completely different property in a different market at a completely different time. And cap rates are entirely sensitive to all those factors.
Cap rate could be different in the county for different properties, correct?
Correct.
You could have one cap rate in a section of the county where you have $2 million homes, and another cap rate where you have properties that are valued at less than at 100,000. Is that correct?
Absolutely.
I just want to make sure I'm clear. Your position is that the value of the assessed value for a house should be determined based on whether or not, based on who owns the house and whether it's a corporate owner that rents it or a homeowner that doesn't, that lives in it.
Yes, I believe that for an income producing property, the income approach should be the primary method of valuation.
And if a property is income producing on the January 1, 2019, you believe that the income approach should be the primary value, correct?
Yes.
And if on February 1st, 2019, that property is now, the owner of that property decides to occupy it instead of own it, you're not aware of any provision in North Carolina law that would allow the county to change the value for subsequent years, are you?
Your Honor, I renew my objection to that question.
Well, I think that's relevant. Let him answer it.
No, if your question is if I'm aware of if I'm aware of a North Carolina statute that would require a change in the way of valuing, I'm not aware of that.
So if the property goes from, if the person who owns the property and rents it on the reval date, he gets one value, and then the next year, somehow the county is supposed to know that he's living there, and therefore we need to change the value to a sales comparison approach. Is what y'all are advocating.
Well, I guess I'm advocating for the county to use the most relevant approach for that particular property that's being valued, and for an income producing property, the income approach is the best approach to use.
The Property Tax Commission and the North Carolina statute provides that the county is to assess property based on true value, which is market value, the price estimated in terms of money in which property would change hands between a willing and financially able buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of all uses to which the property is adapted and for which it is capable of being used. America Homes for Rent position is that you need to take this definition of true value and modify it for commercial properties having one standard and non-commercial properties or non-income producing properties a different standard. Is that your testimony?
Yeah, I feel that for all income producing properties, that the income approach should be utilized as the primary approach to value. Just as I don't know exactly how Mecklenburg conducts its valuations for all properties, but I would consider. I would assume that for other income producing properties like office buildings and apartment complexes, any kind of income producing properties, that Mecklenburg County uses an income approach for those properties as well.
Apartment complexes, office buildings, shopping centers, they primarily transfer or sold based upon income valuation, correct?
Yes.
And There are over 258,000 single-family residential homes in Mecklenburg County. And your America Homes for Rent has 2,600, like I guess that's about 1%. The majority of homes in Mecklenburg County are sold on this market approach where property is either listed with a real estate agent, MLS, maybe for sale by owner, but not sold as a portfolio. You would agree with that?
That the majority of homes are bought and sold on the MLS.
Yeah, or open market, as opposed to you're being bought and sold as a portfolio.
Yeah, I would think that would be the case. Although our homes, just to clarify, are bought and sold on the open market.
Yes, and when you do buy, do you have my Exhibit 5 in front of you or not? County Exhibit 5?
I had the same exhibit that Mr. Wood had.
Okay, that's fine. I don't have any other questions.
But maybe
Okay.
redirect.
Redirect, Mr. Shaheen.
Thank you so much, Mr. Chairman. And again, apologies for I wanted to turn my video off so that there wouldn't be a problem there.
Thank you.
Mr. Brown, just returning back to Mr. Adden's contention, and I do want to address Mr. Commissioner Wheeler's question. Is the value of an asset in taxation that is based on commercial activity based on what?
It's based on an income approach to value.
Do you, as American Homes for Rent, receive income for rental properties?
Yes.
You do not participate, and your primary purpose of business is not to purchase and or sell homes for profit.
Correct. It's for the long-term holding and the benefit of the cash flow that a property generates over a long period of time.
And in your expert opinion as a property tax analyst, can there be two commercial properties that sit side by side, that are identical, that have different values based on whether one is owned and one produces income?
Yes, they could have different values.
So all is American Homes Rent contention that they wish to be treated like every other commercial entity in this state and be given the benefit of an income approach to their rental income.
Yes, that's exactly what we're asking.
At this time, I have no further questions, Mr. Chairman.
Okay, Mr. Adden, Recross.
Your position is that America Homes for Rent should get the benefit of an income approach, even if the income approach does not result in true value or market value.
Objection, Your Honor.
Well, Mr. Adden, why don't you rephrase that, I think.
Mr. Shaheen has stipulated that the county sales comparison approach was done correctly. And the law presumes that the county's assessed value is correct.
Your Honor, Mr. Chairman, if I may, we're going to go ahead and address this.
Let me handle it. Mr. Adden, this is a novel issue here as to whether property that's used for rental purposes, even though it's a residential house, should be one of the three methods for determining true market value is income. And so that's what he's contending in this case should be considered. So ask your question in light of that.
So if the county's evidence is that the county considered the income value, and even after considering the America Homes for Rent's income information, it still assessed the values at $167,500 for Goldworthy Court and $205,000 there. if that's the county's evidence that it did in fact consider your income numbers, but still believes that the market value is the county's assessed value, then in your opinion, the county has complied with your request, correct?
If the county, yes, if the county used an income approach to value the property, then yeah, that's what we're asking here today.
It's not really if they use the income approach, it's if they consider the income approach, correct? That's what the requirement is, that you consider all three approaches to value.
Yes, but yes, I believe all approaches should be considered. But again, given the nature of this type of asset being a rental property that produces income and expenses, that the income approach should be the primary approach used to value this property.
Anything further, Mr. Adden?
One moment, please. I have further questions.
All right. Let me ask Mr. Shaheen and Mr. Adden at some point in time, if y'all can address, this appears to be a not just a North Carolina issue, but I guess it's based on this being national companies and this being kind of a new trend, that this issue may be going on in other states. If you have any information on other states that have property taxes and have similar statutes to what we have, if you can share that with us at some point in time as to how they dealt with this.
We will actually be presenting information on that
Okay.
later on with our further testimony.
Okay. All right. Your next witness.
Mr. Chairman, Mr. Guest has a question. Commissioner Guest has a question.
Okay, I'm sorry. I can't, with this grid, I can't see. So
not a problem, sir. Just
want
to bring it to your attention. Thank you.
Unmute and let me know. I'm sorry. Excuse me.
You're
Mr.
fine.
Guest.
Thank you very much. Mr. Brown, are you familiar with the types of leases that you give your tenants on these single-family residential homes?
I am.
Okay. And are your lease agreements, are they by the month? Or are they for 6-month periods? What's an average normal residential lease?
The average lease that I've seen is generally 1 year in term.
Okay.
With, there are usually options to renew.
Okay. Do your leases have provisions for standard cost of living increases?
I'm not certain.
Okay. When an individual lease, let's say it's a 1-year lease and now it renews. When it renews, does the company reevaluate current market conditions for rent, and is it possible that the rent would increase?
Yeah, I believe all market factors are taken into consideration, as well as the tenant that's at the property, and but yeah, I'm certain that that market conditions are a factor.
Okay. Would you feel that an individual who owns a single family residential property that then rents that property to an unrelated person should also be taxed in the same manner as a corporate entity that leases a property that is a residential property?
If there's a lease in place and it's an income producing property, then yes, I believe that any property that has income data could be valued on an income approach.
Okay, thank you very much.
All right, Mr. Brown, let me ask you in this situation, this new, I guess it's new to us, concept. The cap rate, you indicate that the cap rate, Mr. Wood did, is kind of determined by the investors, but in dealing with appraising property and the county's obligation to do it, they have to have uniform standards. So are you contending that within Mecklenburg County, there would be a different cap rate determined based upon what the investors say they need and for that particular home in that particular area, I guess?
Well, I would say that this cap rate that was selected for this particular these particular income approaches was based on the expected return that our company would be looking for in this market at this point in time. And so that could be different for other companies and other investors.
Well, if the county is, if it's determined that the county does need to do an income approach analysis on this, would you expect that they would have to derive a different cap rate from for each of these properties, or would they be looking at an overall cap rate determined by some uniform standard that may be published or something that would allow them to determine a fair market value if they use the income approach, since it seems that the cap rate is certainly one significant factor?
Yeah, I mean, I think the county could consider other various sources they may have in selecting a cap rate. This was our source, which we felt like was most indicative of what was happening in that market at that time. But if there were other sources, whether it be surveys or other comparable sales of similar property types that the county was able to derive cap rates from, then they would have, but by all means, the authority to do that.
Okay. Mr. Let's see any other questions right now. Mr. Shaheen, your next witness, please.
Yes, Your Honor. Thank you, Mr. Woods. You were excused. Brown, you were excused.
Well, wait a minute.
Go ahead, Commissioner Guest.
No, well, let me handle that first.
I apologize. Before you release these individuals.
Yeah, I'm not going to release them. Mr. Shaheen, you don't do that. I do that, okay? And Mr. Guest has a question, and then we'll check and see if anybody
has any
further questions, and if not, we'll release them, okay?
Thank you.
I'll direct this back to Mr. Brown. Mr. Brown, because you're familiar with the lease agreements, do your lease agreements have any termination clauses where your company can terminate the lease for the end of a lease term?
I don't want to say for certain. Mr. Wood may have a better, maybe more familiar with that particular part of the lease.
Okay. Then we'll ask Mr. Wood.
All right, we'll call Mr. Wood back just for this limited purpose without, since this is virtual, it's a little different. We can handle it a little different. Mr. Wood, can you answer Mr. Guest?
No objection, Your Honor. Yeah, Commissioner, Mr. Chairman, go ahead.
You're muted, Mr. Wood.
Thank you. I don't believe there is a termination clause outside of non-performance by the tenant. So if the tenant is receiving HOA violations or non-payment of rent or abusing the property, then in those situations, yes.
Thank you both.
Okay. Mr. Shaheen, this case is interesting. It's new, it's novel. These witnesses have different information. There may be things that arise when we're hearing the county's evidence that causes us to need to ask further questions of your witnesses. So I think we need to keep them on.
Understood, yes, sir.
This is not the normal.
No, sir, it's not. I apologize for that. I know it's novel and new, but
all right.
I appreciate the time.
Okay. Your next witness.
Yes, sir. petitioner calls Mr. John Bosworth.
Good morning.
Good morning, Mr. Bosworth. Thank you so much for your time. If you would please review for the commission your education, experience, and certifications.
I will. I'm John Bosworth. I am an MAI SRA. I am the Senior Managing Director of Alberts Property Advisors in Charlotte. I'm certified in North Carolina, South Carolina, and Georgia. I'm also a appraisal standards instructor for the Appraisal Institute, as well as business practices and ethics.
Thank you. And you have testified before this commission before and offered opinions of values as well as opinions on valuation methodology.
Yes, I have.
At this time, Mr. Chairman, I would request that Mr. Bosworth be certified as an expert as to valuation methodology, and he will not be offering an opinion of that.
All right, any objection, Mr. Adden? Hearing no objection, so admitted.
Thank you. Mr. Bosworth, can you please describe for the commission the standards in the industry for the valuation of portfolios of residential rental homes?
So when valuing residential rental properties, it's my experience that all three approaches are considered. As previous testimony, we've heard that repeated over and over. And for income producing properties, not to beat a dead horse, but the income approach is typically the one considered most strongly in an appraisal report.
And can you describe for the commission how prevalent these large portfolio commercial residential owners have become and what their entry has done to the market?
They're a growing part of the market, and they continue to be so. It's our experience that they operate in a similar manner as multifamily. Even though they're detached residences, they're valued and viewed by investors based on their income production capacity.
Now, can you describe for the commission what one of those appraisals would look like and how that you would perform one?
Sure. Of course, all three approaches would be considered: cost, sales comparison, and income approach. And, finding multiple dwelling sales would be the preferred method of the sales comparison approach, since you're valuing the universe of properties instead of individually.
Mm-hmm. Now we've heard testimony about the true value concept from Mr. Adden, as well as market value and market price. All things being equal, sales and income approaches should match, correct?
In theory, one should support the other, correct?
Now, given the differences in residential sales to homeowners and residential sales to commercial owners, as well as how those are used, why would the income approach produce a different methodology than the sales approach?
All things being equal, they shouldn't.
Mm-hmm. And in this specific instance, are there major differences, in your opinion, between the type of commercial owners that American Homes for Rent are, and those that purchase as home buyers? What are those differences?
So most home buyers purchase for owner occupancy. Seems to me that American Homes for Rent is operating a business. So their level of sophistication is different from the typical home buyer. And since they're operating these houses as income properties, then they would consider some of the elements that have been discussed so far this morning, like vacancy, capitalization rates, and expenses, where a homeowner wouldn't even think about that.
So it would be appropriate to say that while the sales approach can produce a cap, similar to how the North Carolina case law has produced caps and other methodologies, you have to consider and should primarily consider the income approach.
For an income producing property, it goes hand in hand. There are commercial properties that are not typically leased, like places of worship, where no income approach is possible. Mm-hmm. Or maybe in some cases that is. But for commercial properties that are leased, the income approach really cannot be ignored.
Okay, so that's a wonderful point. So let's drill down into that. The price paid by residential homeowners does not necessarily reflect the income earning potential of a property, correct?
Typically not.
Typically not. And commercial income producing property owners are far more sophisticated than traditional residential homeowners, correct?
Agree.
All right. Now let's turn to exhibits 5 and 6. You've had an opportunity to review those, correct?
Yes.
Are those income approaches standard in the industry?
The order and format and flow of this income approach that we're looking at in Exhibit 5 is typical format for an income approach, yes.
Okay. And for exhibit 6 as well?
Yes. The only caveat is this. Typical income approaches don't have a loaded capitalization rate that accounts for the tax rate. But for tax appeal purposes, we typically see the loaded cap rate without property taxes being an expense. That way, there's no circular reference.
So these income approaches are actually what you typically see submitted for valuation on the income approach to the assessor's office.
The structure of this income approach is typical for this type of case, yes.
Okay. And then turning again, let's go back to you were on the call. You saw us discuss the North Carolina appraisal manual. Do you agree that the primary, as they stated, that the residential rental homes should be valued based on the income approach?
All three approaches should be considered. In a perfect world, all three approaches would be identical, right? So in the residential world, it's been my experience that a rental property must be valued by the income approach, and most clients would expect for an income approach to be performed on a residential property that is rented.
And can you describe for the commission the difference in appraisal methodology between a residential owned and resided in home and a residential home that is rented? Because I know that Fannie Mae and the appraisals are different, correct?
Well, the sales comparison approach is done the same way. There's no difference. And but most single-family residential homes that are bought and sold are not valued based on the income approach.
Okay, but when you're doing an appraisal on an income-producing property, what changes in those appraisals?
Well, you have to consider whether or not the rent is market or not. You have to consider vacancy, typical vacancies. You have to consider operating expenses that would be incurred by the landlord, and of course, capitalization rates. So it's a bit more sophisticated to do an income approach. You can also do a gross rent multiplier, a more simplistic approach, but a direct capitalization approach, as is indicated in these exhibits, is a bit more sophisticated.
So in your expert opinion, you believe that North Carolina should use and consider the income approach in valuation of residential rental homes?
I think the universe should consider the income approach in this property type.
No further questions, Mr. Chairman.
Mr. Adden?
And if the testimony from the county officials are that the county considered the income approach in valuing these properties and still came up with the value of $167,500 for Goldworthy Court and $205,000 for the Capella Court property, county considered the income information, including the income information presented by the America Homes for Rent, then the county would be in compliance with appraisal standards.
If that's a question, yes, I think so.
You're not saying that. I guess my question is, are you saying that the income, whatever value the income approach comes with for residential rental properties, that value should be used regardless of whether that is true value?
I'm saying that value should be considered, just like you're saying. That income approach value should be considered.
And you agree, though, that the North Carolina standard set forth in NCGS 105-283 is to value all property in accordance with its true value, willing buyer, willing seller.
Correct.
And we do not value property based on who owns the property.
Correct.
So if you have two houses side by side, exactly alike, one of them is owned by America Homes for Rent and is rented out, and the value of the income value approach to that is $132,000. And the other property right next door is owned by the occupant, and the sales approach value is $167,000. Is it your testimony that those two properties exactly alike should be valued differently?
If the two properties are exactly alike, they should be worth exactly the same.
And if the sales comparison approach used by the county produced true value, then that would be the preferred approach regardless of what value the income approach came up with.
I disagree.
You disagree?
I disagree.
So if the county sales comparison approach produces true value, but you think that the
I'm
county should be-
gonna object here just for 1 minute. The use of true value here is a determination for the commission. And I believe that the assertion that Mr. Adden should be making is.
Yeah, Mr.
that
Adden, there's three approaches and they're arguing one approach. So let's confine it to not
well-
excluding that.
My question
Good
for
question.
Mr. Bosworth is, true value is defined by the North Carolina statute. It shall be interpreted as meaning market value. That is the price estimated in terms of money at which the property would change hands between a willing and financially able buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of all the uses to which the property is adapted and for which it is capable of being used. That is the definition of true value that I'm using, the statutory definition in 105-283. So my question is, if the county sales comparison approach results in true value, but America Homes for Rent income approach does not result in true value, what amount, how much consideration should
Mr.
an
Adden,
appraiser
I
give
think the way
to
you're
the
phrasing
income
that
approach?
is confusing. So we've got to determine whether or not income approach is one of the permissible methods in determining the valuation of property when it is rented, when it's a residence. And so the distinction here is the rental and how we have to deal with it. So let's keep it relevant to that.
The
We
house is-
understand that you're arguing that sales is your determination that that's the best determination of true value. But income approach is another one that can be used, and that's what we're trying to determine in this case, if that is another appropriate method to determine. And you can argue that it's not. Okay.
Mr. Bosworth, if the income approach is properly used, your testimony is it should result in close to true value, or close to the sales approach value, correct?
Let me clarify that, but without giving you a yes or no, and I think this might help everyone. If you're trying to sell the subject property and that subject property is operating as an income producing property, then your typical buyer would be an investor, not an owner occupant. So that's the distinction. The owner occupant buying a home will pay one price. An investor looking at an income producing property might pay a different price. That's the distinction, in my opinion.
But the property that is at issue here is a single family residential home, period. Correct?
I understand.
And it's used by people to live in, sleep, eat, raise their family, mow the grass, go to school, have fire protection, have garbage service, have police protection. And according to America Homes for Rent's income valuation of these properties, it is considerably lower than what the value would be using a sales comparison approach. So if you do have two properties exactly alike, exactly alike, your testimony is that they should be valued differently based on who owns the property.
Yes, another thing to consider is with a tenant situation, you don't necessarily have a similar level of maintenance. I mean, there are all sorts of differences when you have a tenant occupied property versus an owner occupied property, not to mention the pride of ownership concept.
And what's the county to do if we go with this route, this theory? What's the county to do when a property is owned by somebody and renting it on January 1, 2019, and then 2 months later they decide to live in it themselves? How's the county supposed to revalue that property?
I don't know.
There's no statutory authority to revalue the property.
Don't know.
I'm gonna make an exception here for 1 minute. That question is a little bit prejudicial, and here's why. Because the county can't revalue it, but a homeowner also can't consider information past the date. If the house burned down and the value was nothing, they still could not use that information past the date of revaluation. So I believe this question is not only irrelevant, but somewhat prejudicial.
Well,
That's incorrect, Larry. If the house burns down.
Mr. Adden, we've allowed the question, and he's answered it, and we'll have to determine if that's relevant in our proceedings to determine true value or not. Let me.
I'm
Mr.
sorry, I did not hear Mr. Adams' response.
Okay, Mr.
I heard your
Adams' response or Mr.
Chairman Hunter.
Bosworth's response? Ms. Garrett, whose response did you not hear?
I heard the objection, and then Mr. Adams was responding, but I wasn't able to hear it. There's some talking over.
My response was that if a house burns down after it has been valued, then that is a change in the property, and the 105-287 allows the county to take into account that the house is burned down for the next tax year.
All right. And Mr. Adden, you're still examining Mr. Bosworth.
Yeah. Mr. Bosworth, do you have the county's exhibits? The county's exhibits, or just the taxpayers?
Just the taxpayers' exhibits.
I'm going to read you from County Exhibit number 2, which is an IAAO standard on mass appraisal of real property, standard 4.6.1, single-family residential property. And I'm going to ask you if you agree or disagree with this statement.
Okay.
4.6.1, single-family residential property. The sales comparison approach is the best approach for single-family residential property, including condominiums. Automated versions of this approach are highly efficient and generally accurate for the majority of these properties. The cost approach is a good supplemental approach and should serve as the primary approach when the sales data available are inadequate. The income approach is usually inappropriate for mass appraisal of single-family residential properties because most of these properties are not rented. Do you agree with that?
Yes.
And you familiar with the North Carolina School of Government?
No.
Well, Shay Denning, the North Carolina School of Government is based in Chapel Hill and gives advice to assessors, tax collectors, government, all sorts of agencies, local government agencies. Shay Denning with the North Carolina School of Government did a guide to listing, assessment, and taxation of property. It's Mecklenburg County Exhibit 25. And I'm just going to read from her book and ask if you agree or disagree with this statement. On page 96, she says, the sales comparison approach, as the title indicates, compares the property being appraised with similar properties that have recently sold. This approach is most applicable when sufficient sales data are available for similar properties. It is commonly used to appraise single-family residences and land, but also is an effective approach for valuing multifamily and commercial properties where sufficient sales data for these types of property are available. You agree with that?
Yes.
So even with commercial properties, office buildings, strip shopping centers, and the like, where you would have an income approach valuation, you can also use the sales comparison approach to value those properties, correct?
That is correct.
Now, you mentioned, well, there was some talk about, but are you familiar with the Uniform Residential Appraisal Report form?
No.
Are you
No.
the form that banks have appraisers use when they are doing appraising of single family residence?
Forgive me, I got mixed up with the acronyms. The URAR form is how I think about it. So yes, I'm familiar with that form.
And that's that form. It's about, I don't know, 4, 5, 6 pages, and it has all the information about a single family residence, correct?
That's right.
And that's what we're talking about today, single family residence.
Correct.
Okay. And then it has a little grid. It has for comps. I think there are 3 comps available on that grid where an appraiser will look at for comparable sales of similar properties, correct?
Correct.
And they make adjustments for similarities and differences, correct?
Correct.
And sometimes you might even have a second page that has a couple extra more comps if you want to have more than 3 comps, correct?
Yes, sir.
And the appraisers use that for valuing single family residential properties for people that are buying them, and also for lending institutions that are going to be borrowing money secured by the property, correct?
That's correct.
And these single family residential appraisal reports, they do have a section for the cost approach, correct?
Yes.
And they also have a section for the income approach, correct?
Yes.
And the actual income approach section for single family residential appraisals on this form is not a capitalization approach, it's a gross rent multiplier approach, correct?
Yes, that's correct. It is an analysis of the income production capacity of the property. It is a GRM, a gross rent multiplier. It uses rent and gross rent multiplier extracted from the market.
So that if somebody was actually buying a piece of property and they don't know if they're going to live in it or rent it, there's some information about what it might or might not rent for and what the value would be based on the income approach.
Correct.
And are you aware that the certification for that on the Uniform Residential Appraisal Report form, the appraiser certifies, and I'm going to read it to you. I develop my opinion of the market value of the real property that is the subject of this report based on the sales comparison approach to value. I have adequate comparable market data to develop a reliable sales comparison approach for this appraisal assignment. I further certify that I considered the cost and income approaches to value, but did not develop them unless otherwise indicated in this report. My point is, appraisers, when they do single family residential properties, they appraise them primarily on the sales comparison approach, correct?
So we've talked about the 3 potential approaches, and in that language that you've read, I'm not familiar with that specific language. It's been a while since I've seen a URAR form, but that language is intended for the appraiser to put most emphasis on the sales comparison approach, because most single family residential properties are owner occupied and not income producing.
Just 1 minute, please. Are you aware that the actual subject properties here, the one on Goldworthy Court and the one on Cavella Court, were actually listed on MLS in prior years?
I had no idea. No idea.
believe that's, those MLS, listings are Mecklenburg County exhibits 11 and 20, for the commission. And I just want to be clear, you're not here to give an opinion of the true value of 6110 Cavella Court or the true value of 3319 Cavella Court.
Yes, sir, that is correct.
No further questions.
Okay, redirect, Mr. Shaheen.
Yes, thank you so much, Mr. Chairman. Mr. Bosworth, just a few questions for you to draw some distinctions. Mr. Adden has really brought home this concept that all single-family residential homes should be treated the same. But in your opinion, should you treat a single-family residential home that is occupied by a homeowner and a single-family residential home that has an income stream the same?
They can't be the same because, like I said earlier in my testimony, that the typical buyer would be different.
Okay. Yeah. All right. And then just drawing back to Mr. Adden's, he read to you straight from the book on 4.6.1 on single family residential properties from IAAO. Is it your opinion that properties that are rented and are participating in commercial activity are different than the traditional single family residential home?
Can you be more specific? Well, are they different? Yes, they're different because one's tenant occupied, one is owner occupied. So yes, I agree.
Okay. So and the tenant occupied property, they participate in commercial activity, correct?
Can you rephrase that?
They are doing business. They are generating business off the rental stream.
The owners are.
Okay.
Yes.
Thank you for that. And I'm actually going to use the county's exhibit number 26, and I'm going to use the rule of completion to read through the remainder of that guide to listing, assessment, and taxation of property. Mr. Bosworth, I'd like for you to listen and agree or disagree with this statement. The third approach, the income approach, is generally accepted as the most reliable method for determining the market value of investment property. This approach is based on the principle that something is worth what it will earn. Under the income approach, the assessor arrives at valuation by applying a capitalization rate to the property's potential to generate income, plus or minus certain adjustments. The analysis must be based upon market rents rather than contractually restricted rents. The value property under the income approach, the assessor must analyze the quality, quantity, and duration of the income stream and apply an appropriate capitalization rate to convert the stream to market value. Do you agree that is the correct approach for the homes we've discussed in this case?
Yes.
As the primary approach?
Yes.
No further questions.
Okay, Vice Chairman Weaver.
I have a
Let's see. Mr. Adden had some recross. You want to do your question before he does his recross?
Yes, Mr. Bosworth, you said you were asked by Mr. Shaheen about the use of the properties are different in that one is owner occupied, the other is rented. The use is different to the owners. The use of the occupancy of the two buildings are the same, correct? They're single family residential use.
Correct.
Okay.
All right, Mr. Adden.
Mr.
Oh, wait a
Bosworth.
minute. Mr. Guest, Commissioner Guest has a question.
Thank you. And sorry, Mr. Adden, it might be better just to wait for a moment. So, Mr. Bosworth, I'd like to ask you a couple of questions. The very first question I have, and this is going to go back to Taxpayer Exhibit 5 and Taxpayer Exhibit 6, which is what they've presented as their income approach.
Yep.
First question. Whether you have knowledge or not, you can tell us. Do you have any knowledge if the total gross income that they have presented is market rent compared to contractual rent?
I do not have any opinion on that. I have no answer.
Okay. Next question. You have indicated that the presentation of the income statement here is industry standard. If we
Correct.
go down some items though, I wanted to ask you if there could be variances. So the very first thing is we have a management fee, which says 7.5% of effective gross income. Could it be possible that that is their management fee? But if we had two identical properties sitting side by side, mirror images in every way, and both properties are also rental properties. However, property number one is rented by someone, ABC company, property number two is rented by EFG company. Is it possible that there would be two different management rent commission structures?
Yes.
Okay. And would you say that if one property had a higher or lower management rent structure, that would impact the net operating income?
Yes, it would.
Okay. How about with the replacements for reserves? This is stated as a company standard for the Charlotte market. Does that necessarily mean that that is a industry-wide standard that is used by all management companies across the board?
Typically, we see the replacement for reserves expense for multifamily. And those are basically money put aside to repair short-lived items.
Yes, and my question is, could one company have one percentage or amount that they charge for a replacement reserve compared to a second company?
Yes,
Would they be different?
they could be different. Yep.
Okay, let's go to the
Yes.
top where it talks about lease vacancy rate. The vacancy rate here, they've indicated is actual for the Charlotte market, and that's their actual lease vacancy rate. But again, going back to the hypothetical of we have a second mirror property exactly next door, is it possible that that property could have a different lease vacancy rate if it was managed by a different company?
Yes. Yes, sir.
Okay. And would you say then that if there was a different lease vacancy rate, higher or lower, a different management fee structure, higher or lower, or a different replacement reserve fee, higher or lower, that would impact the net operating income of that particular property?
So I want to say yes, but I just want to qualify that answer. These expense estimates should be based on historical information from the property itself, from expense comparables. So there are all sorts of ways of supporting each and every one of these operating expenses. And I am under the assumption that this property owner has access to multiple examples to support each of these. For example, property taxes is the easiest one, although it's taken out of this because we're a tax appeal. But the property tax expense is a known expense and it's publicly known for Mecklenburg County. But the rest of the expenses should have some method of support.
But if we're trying to value a piece of property based on the net operating income, and we have two properties side by side managed by two different companies, efficiency of management, the ability to rent the property, better maintenance compared to lower maintenance would impact reserves. Could any of those items impact the net operating income? That's my question.
Yes.
Okay. And if they could impact the net operating income, then my next question has to do with a capitalization rate. Now, the company here in this example, this company has said they have a capitalization rate that their investors desire. Okay. But could another management company have a different capitalization rate that their investors desire? Higher or lower?
The same can be said for another appraiser could have a different opinion of the capitalization rate. So yes, higher or lower.
Okay. So the capitalization rates could be higher or lower. Would you say that there are industry publications that publish standard capitalization rates that investors are looking for various types of property, whether they're residential or duplex or commercial office buildings or various things?
Yes.
Okay. And if the net operating income, based on my example of vacancy rates, repairs and maintenance, management fees, if the net operating income on two identical properties were different and the companies used different capitalization rates on their income approach, would they each arrive at a different valuation that they would think the property is worth from an income approach?
Of course, yes.
Okay, all right. So now if we could have different valuations on two properties that are side by side on an income approach, and now we're doing a proper appraisal, and we've looked at the cost approach, sales comparison approach, and the income approach, and you're the appraiser and you're reconciling these items out, how do you go about reconciling a large difference between the sales comparison approach and the income approach? Do you have to wonder if the income approach could have excess expenses or not fair market rent or some item that would make it lower? Or do you have to look and see, is there a difference in my sales comparison approach? Do you have to make adjustments to balance these? You said they should be similar.
Correct. So when reconciling between two approaches that might be disparate, we then revisit the credibility, the inputs, the assumptions that are made, and the support for the different components. So that's where the opinion, the expertise comes into play for an appraiser to look at whether or not the inputs for the income approach are reasonable and supported.
Okay. And you have not independently examined, verified, confirmed, or in any way have an opinion on this income stream evaluation that's been presented to us. And you have also, I'm assuming, not looked at the sales comparison approach that the county's done and formed any opinion on that. You're just here to talk about methodology of appraisal. Is that correct?
That's correct.
Okay. Thank you very much.
Thank you.
I have no further questions. Commissioner Guest covered it very well.
All right, and then is that your last witness, Mr. Shaheen?
Yes, Mr. Chairman, that is my last witness.
Okay, we're going to consider all the exhibits that have been submitted to be admissible. I don't think there was any objections to any of those. And so you're finished with your evidence. It'll shift to the county. Mr. Adden, we're going to need to take a break probably. So do you want to make a motion, or what's your intentions?
My intention is to make a motion to dismiss.
All right, we'll hear that, and then we'll take a break, and we'll come back after lunch and announce our ruling on that after we've discussed it.
Okay.
Okay, Mr. Adden.
Yeah, thank you. As this commission well knows, county's assessed value is presumed to be correct. In order for the taxpayer to prevail, the taxpayer has to show that the county used an illegal or arbitrary method of evaluation. And this is what's so important, that the assessed value substantially exceeds true value. Now, the fatal flaw in the taxpayer's case here is, the absolute easiest fatal flaw here is, there is no evidence presented by the taxpayer of what the true value of these properties are. None whatsoever. They hire an MAI, and he comes in and he testifies about methodology, but he doesn't testify about what the true value of the property is. Mr. Brown, who testified, his resume, Mr. Brown's resume, which is exhibit number 2, his resume talks about he's established a nationwide network of property tax consultants and lead efforts to present valuation protests and appeals to assessment officials for purposes of generating substantial tax savings and improving NOI using all 3 approaches to valuation: income, sales, and cost. Mr. Brown has a nationwide expert of people, but did not bring anyone to come in and testify. What is the true value of 6110 Goldworthy Court? What is the true value of 3319 Cabello Court? There is absolutely no testimony of true value. So without that testimony, without some testimony, they cannot prove or establish an element that they have to prove under the AMP case, that the county's assessed values substantially exceed true value. And of course, the reason they haven't attacked the county's value sales comparison approach is because the sales comparison approach produced true value here. So the county primarily relied on the sales comparison approach. These properties, we stipulated in the pretrial order that these properties are 2 single-family residential properties. The taxpayer contends that you should use the income approach because they are commercial, they are institutional, they ought to have a break. Well, what they're asking for is a change in the legislation. They want property valued based on who owns it, not what its use is. This use of this property, these homes, is single-family residential. That is the use, clear and simple. It's not single-family residential for rental purposes. These homes were previously on the MLS. They were marketed on the MLS. Anybody could, if they put these homes up for sale, anybody could buy them and use them for owner occupancy. There is no statutory preference for valuing property based on who owns it. So there would be gross inequities for the county, for the commission to accept the taxpayer's theory of this case. Okay, it's not, again, as Vice Chairman Wheeler asked the question about 2 houses side by side, should they be valued differently? And the witness never really answered the question. And the reason he didn't answer the question because he didn't want to. You got 2 houses exactly alike. One house is owned by the occupant, one house is owned by a corporation that rents it out. The occupants of those houses are both using them for single-family residential. As I said earlier, same police, same fire, same school, same governmental services. The statute 105-283 talks about uniform appraisal standards. It doesn't talk about one appraisal standard for a corporation and another appraisal standard for homeowners. There is no reason why we should treat these houses differently. Now, the county's, they also have to show that the county's method evaluation was illegal or arbitrary. And you heard all the testimony, IAAO standard, sales comparison approach, North Carolina School of Government, sales comparison approach. It's the best indicator of market value. North Carolina Department of Revenue, sales comparison approach, the best indicator. It's used. So the fact that the county uses the sales comparison approach, that's not illegal and that's not arbitrary. The fact that they consider all 3 approaches to value, if you look at our property record cards, we got cost information in there and everything. We consider. The county has a system Mr. Shaheen is taking full advantage of, where if the taxpayer doesn't agree with the property value, he can appeal it. He can have an informal review and present his evidence. He can present evidence to the Board of Equalization and review. And if the taxpayer, as the taxpayer here did, presents its income information to the county, we're going to consider that information. But in this case, that information does not result in true value. Had a case, this very commission had a case 2 months ago. On February 17th, 2021, just 2 months ago, We had the repat leasing case. I don't believe you've entered a decision yet from that case. But you'll recall that was a case of commercial property.
Well, Mr. Adden, if that's still under review, let's not get into that. We haven't rendered a decision on it yet.
Well, you'd have rendered a decision. You supported the county's value based on the sales approach, as opposed to the taxpayer's value based on the income produced by a parking lot.
Have we published the decision?
I don't believe so.
Okay, so it's not official till we publish it.
But the question is, so then you get to the question of, okay, they say, well, let's use our income approach. Not an income approach, our income approach. And as Commissioner Guest just brought out in his questioning of Mr. Bosworth, the taxpayer's income approach is not a market approach. It's not market-based. It's based on information that America Homes for Rent has. And what's really disturbing and what really is, you know, as Mr. Bosworth said that, look, the income approach value and the sales approach value, they should be producing pretty equal results. Well, I agree with that. America Homes for Rent says, use our income data here. And what's the critical factor in their income data? And if you're going to use a cap rate, you don't just pull it out of the air. You don't just say, we need a 7% cap rate because our investors demand that. You do a cap rate study. You have a study of the cap rates. And there is no evidence here that the 7% cap rate that they use is a market cap rate. In all of the literature, the exhibits, the Department of Revenue manual and all says, you don't just rely on the actual income. You got to look at the market. What is the market income? What are market expenses? What are market vacancies? And what is a market cap rate? And they did not do that. There is no evidence of what the market is. They just say, this is what we say. And Mr. Wood says, our investors for these two properties want 7%. Well, his exhibit 10 says a required yield of 5%. And if you used a 5%, you get a value in excess of the county's assessed value. And so they not only is there no evidence of true value that they have to have, they do not have any evidence of market information to support their income approach. They want the commission to simply take our value as it is. Now, Mr. Shaheen includes in his materials 3 cases. I assume he's probably going to talk about those 3 cases. And all 3 cases that he put in his exhibits all involve malls, shopping malls, and the valuation of shopping malls. I think one of them involves the valuation of an anchor store, not the mall itself. So those cases are completely different from here. We are dealing with single-family residential homes. But also what's interesting about those 3 cases, in all 3 of those cases, they had, and the taxpayer had an appraiser come into the commission and testify about the value of the property, the true value of the property based on the taxpayer's concern. There's no evidence. They hired an appraiser, an MAI, and Mr. Bosworth is certainly qualified. He could do an appraisal of these 2 properties, I'm sure, based on income, sales, and cost, and come up with an opinion of value, but he has not. But in Belt Broom, Winston-Salem Joint Venture, Blue Ridge Mall, in all of those cases, the taxpayer meets his burden by having an appraiser testify about true value. We don't have that here. The taxpayer's evidence is strictly limited to exhibits 5 and 6 on valuation. And that's not appraisal standards. It's not a market standard. There's no testimony that this is a true market value or true value. How America Homes for Rent buys and sells portfolios. I am sure that Mr. Wood does a great job in valuing property and buys property at less than market value. And when he gets around to selling it, tries to sell it for more than market value. Any good business is going to do that. But just because one business sets forth how they value it, that doesn't become the valuation. So if you look closely at their exhibits, there's just nothing there to establish the true value. For the taxpayer to prevail here, the Property Tax Commission has to unilaterally change NCGS 105-283, which calls for universal appraisal standards that all property, real and personal, shall be, as far as practical, be appraised or valued at its true value in money. That's how you value single-family residential property. True value in money. And the true value of these properties, as set forth by the sales comparison approach, primarily relied on by the county, is $167,500 for Goldworthy Court and $205,000 for Cabela Court. And there is no evidence that those values substantially exceed true value. Thank you.
Okay, Mr. Sheehan.
Yes, thank you, Mr. Chairman. So we're going to talk, let's talk about first the differences. Let's talk about the fact that Mr. Adden, in his motion to dismiss, tries to draw correlations between residential home ownership for homeowners and commercial activity. And I don't disagree with anything he said on the statute except for this. You heard expert testimony today that there is a distinct difference between commercial rental activity and residential home ownership. I don't think anyone on this panel is going to disagree that we currently exist in an environment of inflated home prices and that the sales approaches do not necessarily reflect the accurate and true value in money of what these homes go for. So why does Mr. Adden keep talking about similar houses, similar houses, similar houses? Mr. Adden keeps talking about similar houses because he doesn't want you to focus on the commercial activity, which if you were to dismiss and not treat this business as every other business in North Carolina, you would be disregarding the law and disregarding appraisal standards, which we heard from Mr. Bosworth. Mr. Bosworth himself, expert in appraisal, said that there has to be consideration, not just cursory examination, but consideration of the income approach in developing all three standards. Mr. Adden says that there's no true evidence, no evidence of true value. Well, I disagree. And I think the plain eye test shows that. We have two income approaches. You heard from the evidence that it was correctly done, not just from a gentleman who's certified in this, but also from your expert appraiser, Mr. Bosworth, who said that that approach was correct. Now, I would agree with Mr. Adden if he had an income approach to present to you today or had presented evidence of an income approach that was different. However, that's not the way that our case law or statutes in North Carolina works. The taxpayer does not have to prove by any other burden but presentment of an actual difference in value. And if you want to talk about what it is to be an arbitrary method of valuation, the county has not produced a single shred of evidence to show that the income approach that they would arrive at is different than the income approach arrived at by American Homes for Rent. Because the burden shifts. We've heard from, and the case law is in front of you. I don't need to cite it because the case law is right there. We had an expert appraiser tell you today that the income approach used was correct. We had an expert in tax valuation tell you that the true value in money is X, which is what we applied for these properties. The same individuals talked about the different market cap rates in which they use in different markets and how the differences in value for rent are adjusted for 365 days. We've presented our evidence. It's now the county's burden to show that their income approach as a commercial activity would instead be different. But they can't do that. And why? Because they have not produced an income approach. And for Mr. Adden to say that these two properties are exactly the same is false, because one participates in commercial activity and one does not. And to treat a business as a residential homeowner, as you just heard from the North Carolina Appraisal Standards Manual, from the lips of our own expert, and from the case law you have before you, we have established case law in North Carolina. I'll read it to you. Yes, you're right. I use shopping malls. You know why? Because these are different. These are unique. And this is a case of first impression. So we must analyze these based on that standard. So I'll read to you from the Belt case. The income approach should have been the primary method used to reach value and for anchor store in the shopping mall. And a combination of approaches could have been used. A combination of approaches could have been used, so long as the income approach was given the greatest weight. American Homes for Rent stipulated to the sales approach today because we are not in disagreement with them as to how they developed that methodology. That's not where the disagreement is. Don't get distracted by that. The disagreement today is whether American Homes for Rent deserves the same consideration as any other business in North Carolina doing business in North Carolina. And I will read it again, just to hammer the point home, just to read it again from Exhibit 25. Underlined passage. The third approach, the income approach, is generally accepted as the most reliable method for determining the market value of investment property. This approach is based on the principle that something is worth what it will earn. We have presented competent evidence of a significant difference in value. We have shown that there was arbitrary reliance upon the sales approach without reliance or shown of a development of the income approach. And we have met our burden to provide to you that competent evidence. And while I understand that some folks may have some heartburn, totally agree that yes, there may be a homeowner next door with a tax value different than the business next door. But that commercial activity and behavior exists currently in North Carolina. And I would contend to you that this is actually the correct methodology by which these properties should be valued, because they are commercial activity. They are not residential home ownership. And because of that, a combination of values should be used. Now, that goes without saying. I don't think anyone can disagree with that. A combination of values should be used. And we can come to an agreement, Mr. Adden and I can, on what that value is. But we have to have a determination on what value is appropriate and which value should be considered and what value should be primarily used. The motion to dismiss should not be granted because we have provided that evidence. We have shown expert testimony. We have evidence of a difference in value, and we have shown that they've relied on the sales approach only in an arbitrary way. As such, we believe we should continue.
Okay, we will break until 1 o'clock. We'll come back and we'll be in executive session while we discuss the motion when we come back. All right, 1 o'clock. Thank y'all.
All right, Mr. Chairman, we have everybody back in the session and we are recording in live.
Mr. Chairman, you're muted.
Excuse me, I see Mr. Adden, Mr. Shanine, and some or all of the taxpayers' witnesses. The commission has discussed this matter and has voted 3-1 to deny the county's motion. Vice Chairman Wheeler voting to grant it. All right, we will hear Mr. Adden from you in Mecklenburg County as to why your method is the proper one to use.
Okay, I've called my first witness, Ken Joyner. State your name, please.
Kenneth Joyner.
Go ahead and focus on Ken, not me. And where are you employed?
I am the assessor in Mecklenburg.
And is would
Can everybody hear the witness?
if you would tell the commission a little bit about your
Mr.
background.
Guest, can you hear him?
No, it's very difficult. Don't know if they can put a mic closer to themselves, remove their masks. I don't want them to have to do that if they don't feel safe, but it's hard to hear and understand.
Yes,
Okay.
I was having some difficulty also.
Mr. Joyner, how long have you been the assessor for Mecklenburg County?
I have been the assessor for 7.5 years.
Okay. And what's your educational background in your, you would please?
I am a graduate of North Carolina State University with a bachelor's degree in accounting. I have been in the property tax business now for close to 28 years. I have taken numerous IAAO courses. I hold 2 professional designations through the IAAO. I've been an instructor now for over 20 years.
And what is IAAO?
The International Association of Assessing Officers.
And when you've been an instructor, do you just instruct in North Carolina or other states?
Well, it's up to the individual instructor. I've been teaching across the country now for probably the last 13 years or so.
So you teach taxation assessment to people all around the country in different states.
And different countries. I've taught in Canada as well.
Tell us a little bit about your work experience.
I have been an assessor for probably 20 years. Prior to coming to Mecklenburg County, I was on the faculty at the School of Government doing the assessment, appraisal and assessment administration training for the state of North Carolina through the school. Prior to that, I was in Durham County, Onslow County, and Chatham County as the tax administrator, tax assessor. And prior to that, I was an appraiser in Harnett County, which was my beginning job out of college.
And your resume exhibit 2, it mentions articles and publications and conferences and seminar presentations that you've given.
Yes, sir.
I would offer Mr. Joyner as an expert in the field of mass appraisal of real estate in Mecklenburg County, North Carolina, and also an expert in ad valorem appraisal of real property.
All right, without objection, so admitted.
Now, Mr. Joyner, you were here for the morning session of this hearing, correct?
I was.
At one time, Commissioner Chairman Hunter asked if there was going to be any presentation regarding what other states may have done regarding the treatment of residential property that is owned by corporate taxpayers for rental purposes. You recall that?
I do.
Did you hear any evidence from America Homes for Rent regarding how other states treat rental properties?
I heard nothing specific from any of the 3 witnesses as to whether states were in fact making a distinction and a difference or identifying any states that we could point at.
In your 20 plus years of appraisal experience and teaching courses to other states and other counties and other even countries, are you aware of any states that treat single-family residential rental properties different for taxation purposes than single-family residential properties owned by the homeowners?
I am not aware of any.
Does North Carolina law allow you as the assessor to treat single-family residential rental properties different from single-family residential homeowners property?
It does not.
How are you to treat the two properties?
Well, you go back to the statutes and you go to the definition of true value under 283, and it talks about a willing buyer, willing seller, everybody having full knowledge of the property, nobody under duress. And within that definition, it is implicit that we value at the level of fee simple. And fee simple is unencumbered. It's ownership of all the rights of the property. It's not limited to certain rights. It doesn't take into account whether you're within a lease contract at that point, or if it's not a leased property. We also must look to the highest and best use of the property and try to understand which use is going to bring the highest value.
Let me stop you there. So if you have a single-family residential home and it is owned by a corporation and valued using a income approach model to get a lower value, and you have a similar property that is, well, is that necessarily the highest and best use for a single-family residential home?
It would depend on the market evidence, and based upon their information that they provided, which to me sounds more like an investment value. When you talk about the board of directors of the company who represent those as part of the real estate investment trust and making sure that they get the proper returns, it sounds to me like a clear investment value, because it's the value as it is to the company based on its expected rate of return on the property.
Now, so does the county, when it assesses property for ad valorem tax purposes, does it assess property based on its investment potential?
That would be part of your going through and looking at the property and building your scope of work and gathering your data collection. You would look at all three approaches to value, which would include that the property could be purchased as an investment.
Now, you're familiar with the taxpayers exhibits 5 and 6, the income pro formas for these particular properties.
Yes, sir.
Do you have any issues with their pro forma?
Well, from my standpoint, looking at it, I would agree that the format and the steps taken follow your expected process, but there is no evidence behind the sheets that tell us that their gross income is market levels. I think I heard them say that their vacancy rate was based on their properties. It's not looking at the larger Charlotte market. Their management fee is based on their company's return, which may or may not be the market levels. Their replacement for reserves, their repairs and maintenance, all of those are based on their actuals. So in form, it is following the procedures, but the value all the way down to the cap rate with no market evidence where they've actually developed a net operating income for a property that has sold and come up with a market derived cap rate without any evidence. It just looks like a good example of what an income approach could look like.
Now, when the county does assess properties, commercial properties such as office buildings, shopping centers, does it use an income approach model?
That would be part of our valuation, yes, and we would also look at at sales and at cost data.
And when you're looking at a commercial property like an office building, do you accept the office building's rent and vacancy and expenses as that is the true factors to use in coming up with the value?
No, we look at market levels across the entire county for office buildings, apartments, warehouses, flex space, you name it. We're going to be looking for the market rents and the market levels of expenses and vacancy and collection loss and cap rates within those different segments.
And is assigning a cap rate and an income approach that your investor want a proper method for determining the income approach value of a subject property?
You're gonna have to repeat that one for me.
The American Homes for Rent use their investors cap rate. Is that a proper cap rate?
It may be for them for determining what they're willing to pay for a property, but it is never going to match market value unless their investor expectations happen to mirror the market at that particular point, which at this point on January 1 of 2019, they did not.
Now, you were the assessor for Mecklenburg County when it did the general reappraisal in 2019.
Yes, I was.
Can you just explain to the commission how the county went about its general reappraisal regarding single-family residential homes, which is the subject of this case?
Okay. Of the approximately 370,000 parcels in Mecklenburg County, somewhere just south of 260,000 of those are single-family homes. When you are doing a reappraisal, there's some important information that must be done on each of those properties. You've got to have a good individual property characteristic file, knowing what its square footage is, what its exterior measurements are, is it 1 story, is it 2 stories, is it 1.5, what's its roof structure, what's the exterior siding, what's the heating and air, what's the floor cover, number of bathroom fixtures within the structure, what's the number of bedrooms. You've got to have a good extensive file on each individual property.
And that information you actually put in the property record cards for each individual, all 379,000 parcels in Mecklenburg County.
Yes, we have an individual property characteristic database for each individual property.
And with respect to the subject properties, those property record cards are County Exhibit number 7 for 6110 Goldworthy Court and County Exhibit 16 for 3319 Cabela Court.
Yes.
So you have all this information about the different properties. So how then do you go about specific properties? How then do you go about assessing them?
Well, continuing on the topic of a revaluation, once you've got that individual property data file, then you've got to be able to take your county and divide it up into different market areas. We describe those in our office as tax neighborhoods. And within those 250,000 or so properties, we've got over 1,000 individual property neighborhoods. So now you've got each individual property and you placed each property within a neighborhood. Then you've got to have good sales data. So we look at and confirm and gather the arm's length transactions for each of the properties that have sold. We would get rid of any properties that were not arm's length transactions. And we use those individual sales within each neighborhood to establish a value within each neighborhood.
Is there a time period for sales?
We would look at the last 2 years, 2017 and 2018, as the 2019 revaluation. But if there's enough sales in 2018, we're only going to use those most recent if there's enough ample sales to value the property.
And, so then what do you do with these sales that you look at?
Well, we take those sales, we're going to come down and we're going to come up with a price per square foot for that neighborhood. We're going to compare that neighborhood's price per square foot with what our overall residential base rate is for the entire county. Let's say that the county's base rate is $90 and this neighborhood has a rate of $112. We would divide the 112 by 90 to come up with our neighborhood adjustment to come up and establish that price per square foot for homes in those neighborhoods. Then we use that individual property record for each property to distinguish and value that property based on the adjustments that we've made.
And so you take into account individual characteristics of the specific properties?
Yes, we do.
Now, and then do you do any statistical testing to determine whether or not your values are accurate?
Yes, we do. That's actually one of the items within a mass appraisal that distinguishes us from a single property appraisal world, is that we can go in and measure quality within our final output. That's part of the Uniform Standards Professional Appraisal Practice, that we do have the ability to do quality control.
Why are uniform standards important?
Well, they cover all appraisal work within the United States.
Now, in determining values of single-family residential homes, does the county also consider the income approach?
Yes, we consider both the income and the cost information when coming up with our final values.
And how does that come into play?
Well, when you're doing an appraisal, you have to look at and consider all three approaches to value. We have to look at within residential neighborhoods, we have to look at factors like the number of properties that are owned by individuals, that are owner occupied, versus the number of properties that are rental within a neighborhood. We have to look at the adequacy of the sales data that we have within a neighborhood. If we don't have enough adequate sales, we may need to look further and find additional information or find other neighborhoods nearby that are similar to try to combine them. We also, based on the principle of substitution, all three approaches to value play a part in that valuation, because you're looking for the correct method that market is being bought and sold on. And when you've got the adequacy and the level of sales information, the typical buyer and the typical seller in our residential neighborhoods are purchasing those and selling those as single family homes, not investment properties.
Do you assess single family residential rental properties on a portfolio basis like the taxpayer determines its values?
No, because there has no statutory basis in our laws.
Now, if a taxpayer such as America Homes for Rent comes to the county and in the appeal process provides the county with income information, what do you do with that income information?
We're going to look at it just like we would any information that's provided to us by any of our customers during an appeal process. We look at and we consider whether that evidence reflects any uncertainty in our valuation process. Was there discrepancies that they brought forward that we were not aware of? And we found nothing in the two properties before us today that showed that there was any error in the county's valuation.
Now, let's go through the county's exhibits. Exhibit number 1 is your resume, correct?
Yes,
And exhibit number 2, is that an IAAO standard for appraisal of residential properties?
yes, it is.
You agree with that standard?
I do.
Okay, exhibit number 3. What is exhibit number 3, if you would?
It's a picture of a home.
And it's a multi-page exhibit.
Looks like there's 4 home pictures and then an aerial photo of Goldworthy Court subdivision.
Now, America Homes for Rent believes that its homes should be taxed differently. Can you look at these pictures to figure out if one of these houses should be taxed differently from the others?
No, they all look like they're similar construction, similar age, similar layouts. They all look the same.
And if you're assessing the values of these 4 properties, these pictures, are you going to value them all using the same method of valuation?
If they're in the same neighborhood using the same market data, yes, we would use the same method to value those properties to ensure that there is equity and fairness through the neighborhood.
If you look at the property record numbers, it's 165-073-35, -36, -37, and -38. Would that suggest that they're all next to each other?
I believe so, yes.
And so the subject property here on Goldweather Court is property number 37. That would be the 3rd picture, the picture of the house without any cars on the driveway. If the commission goes with America Homes for Rent's theory, that house would be assessed at $132,000 instead of the county's $167,000. Would that create any issues with the assessment?
Well, if I were a neighbor, I would be concerned that my value was significantly higher than a neighboring property.
And if you look at the aerial photo, the last page of that exhibit, can you pick out the America Homes for Rent house that should be taxed valued differently from all the other houses in that neighborhood?
Not by looking. If I didn't know that, if I knew that the car wasn't in the lot for the aerial photo, I could narrow it down, but not just looking at the photo.
So when Vice Chairman Wheeler was asking Mr. Brown should these two houses that are side by side exactly the same be assessed differently based on whether one is owned by a company and rents it and one is owned by a homeowner, how would you answer that question?
The ownership would not play a factor in the valuation of the property.
The fact that a property is being rented as opposed to the being not rented, should that play a factor?
It's a piece of information, but it should not play a factor in the valuation process. It's just another physical characteristic of the property.
Look at Exhibit 4. These are pictures of Cabela Court properties. Can you tell which one should be valued differently from the others?
No, because there's 2 without cars in the yard.
You can't tell, can you?
No, they all look similar in construction and layout.
Now, let's go to Exhibit 5. I guess the standard that the county attempts to achieve in valuing property is true value, correct?
Yes, sir.
And true value is a market value.
Yes.
Now, can you take the commission through what Exhibit 5 is? And just explain to the commission what we have here.
Well, we've got here we've taken the income approach valuation and we're just going through each of the parcels. So we've got,
Now, let me stop you there. The income approach valuation is an income approach valuation that was done by America Homes for Rent
correct,
for each of these properties. If you look at the supporting documentation following the cover page, correct?
correct, correct.
For instance, the first one is a taxpayer income approach value of 198,400, and that is what the value the taxpayer did on page 27 of that exhibit. You know, page 27 is the follow-up page, correct?
Correct.
And that's using their income approach. They came up with a value of 198,400.
Right.
And
right.
they bought the property when?
They bought the property on May 15th of 2017 for $242,000.
And a copy of the general warranty deed is on county exhibit page 28.
It is.
And that's a North Carolina general warranty deed.
It is.
So is there any explanation why they would pay $242,000 on May 15th, 2017 for property that they value at only $198,400 using their income method?
I've not seen any evidence as to why.
Now, the county's value for that particular property is $265,700, correct?
It is. It is. That sale was in May of 2017. So obviously there was market evidence of appreciation still taking place in that neighborhood up to January 1 of 2019.
What general rate of appreciation, market appreciation did the county, this county use for the 2019 revaluation?
I want to think we used around 5% per year.
So a property that was sold for $242,000 in May of 2017, if you were to value that as of 1/1/19, you would expect the price to increase at least 5.5% or so.
Yes, at least.
And do any of those 5 purchases support what they actually paid, support what they contend the value is under their income approach?
No, they paid more in 2017 for all 5 properties than what their income approach value brought forward to the county was for each of these 5.
And if you look at their income approach values, they all used a value of 7% cap rate plus 1.31%.
Yes.
If that cap rate was reduced down to 5%, like Mr. Wood did when I pointed out, would that indicate a significant change in what the income approach value would be?
Well, a 2% reduction in the cap rate is a huge reduction. So yes, if you lowered the cap rate by 2%, as you did in the exercise this morning with taxpayers' witnesses, in those cases, it brought the value back up to the county's value approximately.
And then it looks like they purchased 2 properties by trustee deed. Now, a trustee deed is not a qualified sale, is it?
No, it's not.
And the reason being why?
Well, typically those are foreclosures or some other duress, and the banks are usually selling those at below market to get them off of their portfolio because they're in the business of loaning money on homes, not owning them.
So you would expect that the purchase prices paid by America Homes for Rent for the properties that they're buying by trustees deed, and there are copies of the deeds in the Exhibit 5, you would expect those values to actually be lower than maybe true value, correct?
Potentially, yes.
And yet on each of those occasions in 2017, they still paid considerably more than what their income approach model comes up with the value.
Yes, in both of those cases, their own purchase price of these trustee deed properties exceeded their own income approach.
And then the bottom part there, the 2 parcels which they actually sold.
I'm going to object here, Mr. Chairman, very quickly. These parcels that Mr. Adden.
Go ahead. Objection to
Yes.
what, Mr. Shaheen?
Yeah, I'm gonna object to the testimony that's about to take place. Mr. Adden's about to ask about 2 properties that were date sold July 18th, 2019, August 26th, 2019. Those took place after the effective date of the evaluation. As such, those properties should not be included in this evidence here hearing today.
Mr.
Well-
Chairman,
Go ahead, Mr. Adden.
yeah, the purpose of this is not to show the true value of the subject properties. We're not using these post-reval date sales to support the county's value. The purpose is that it should, you can see by these two sales that they sold the properties at a considerably higher rate than they contended the value of the property is using their income method. So what I'm saying is their own purchases and their own sales do not support that their income methodology that Mr. Shaheen says was correctly done does not support their evidence, because they say the first one was worth $186,000 by the income approach, yet they charged the guy $235,000 for it. I mean, that's a pretty good chunk of change. And so,
We are ruling on the
All right.
objection.
I'm gonna allow it for that purpose, Mr. Shaheen.
Understood.
all right, so Mr. Joyner, exactly what these are sales of America True Homes for Rent properties.
These are two sales that took place, one in July and one in August after the revaluation date. And both of their sales prices exceeds both the taxpayers' income approach to value and the county's assessed value.
And so do these, well, that's fine. Let's go on to the next exhibit. Well, let's see here. Let's go to County Exhibit number 13. Oh, I'm sorry. Let's go to County Exhibit number 12. What is County Exhibit number 12?
It is a residential improvement report.
And for what neighborhood?
It appears to be the neighborhood Q511, which is where Goldworthy Court is placed and valued.
And the subject property, 6110 Goldworthy Court, is down there on the first page of the report, correct?
It is.
Okay. And what does this report show?
This report is going to give the appraiser who is working the neighborhood the ability to look at the building values of all of the parcels within the neighborhood, the land values. As you can see on the report over the 4 pages, the land value is for all parcels are at 20,000. It gives them the finished area for all of the properties. It tells them the grade of all of the properties. So you also consistently see that we've got these as a C grade homes. It tells the year built, the actual year built, the effective year built, bedroom, bathroom count. So it's a good follow-up report for the appraiser after they've gone in and valued the properties to ensure that they have placed consistency throughout the neighborhood.
You have an AYB. What does that stand for?
Actual year built.
So it looks like a lot of these properties were built in the same time frame. And the EYB means what?
The effective year built.
Now, the Goldworthy Court property was 1,600 square feet finished area,
It is.
and it's valued at 167,500.
It is.
Go up to the top of the page and go down to finished area and tell me the value of any 1,600 or more square foot, 1,600 to 1,700 square foot properties. What are the county's values?
Well, you've got 2250 Dion Avenue at 1,635 square feet. And it looks like we've got that one at 168,000. Go down and you find 6231 Thompson Brook Lane, 1,648 square feet. We'll have to use something as a straight edge here, sorry. $168,300. Well, excuse me, I went down too far. 176,900. The next one you come across is 6226 Thompson Brook Lane, 1,664 square feet. We've got it valued at 168,300.
I think the commissioner gets the point. Are all these properties equitably assessed?
They appear to be, in my opinion, yes.
Now, if the value of 6110 Goldworthy Court was 132,700 as the taxpayer is asking, what would you say to that?
Well, I would say that it would be an outlier within its own neighborhood from a valuation standpoint, because I don't believe there's a property in the neighborhood valued at that level. It would be inequitable with its neighbors.
I mean, there's a 1,280 square foot house right a couple of lines above it that's at 149,800. So they would actually be assessed lower than a house that's 320 square feet less.
Exactly.
Is equity something that you have to consider as the assessor when you're doing a mass appraisal of property?
Yes, you know, I've been in the business for almost 28 years, and in every county I've ever worked in, I've had taxpayers, customers that I talk to, and everybody says, I want to pay my fair share, but no more. And I believe that there would be a significant number of people in this neighborhood and in the other neighborhood that would be disturbed that the ownership of a property granted them a valuation process that came up at less than what their value was.
And that would stick out like a sore thumb on this residential improvement report, correct?
Oh, very much so.
So now let's look at exhibit number 21. What is that?
Residential improvement report for neighborhood C906.
That's for the Covella Court property that's on the second page.
It is.
And the Covella Court property is 1,682 square feet, valued at 205,000.
Yes, sir.
And the second entry on that same page is 1,623 square foot house built in 2002 is at 197.9.
Yes.
Just a little bit smaller, a little bit lower in value.
Yes.
Do those values on exhibit 21, do they appear to be uniform and equitable across the board?
Well, I can note that they all have the same land value. They're all graded as sea-level homes. They have very similar AYB and EYBs, I think all within about 3 years of each other. Yes, I think that size is the only thing that's probably adjusting these values up and down at any significant level. Yes.
So if you were to assess a 1,682 square foot house at 168,100, as the taxpayer suggests, would that stick out?
Oh, yes, very much so.
Because just looking at the page that Covella, that the subject properties on the 1,600 plus square foot houses look like they're assessed at 197.9, 2097, 192.4, 196. So close to the 200,000, not close to the 160,000, or 170,000.
Correct.
All right, so talked about uniformity and equity, and now let's look at taxpayer exhibit number 13. We talked earlier about qualified sales. So what is exhibit number 13?
It's a qualified sales report for neighborhood Q511, looking at sales that took place between December the 19th, 2017 and November 29th, 2018.
And they're not having sales in that neighborhood in December 2018, qualified sales according to this report.
Correct.
And so, now the subject property in Q511 is a Goldworthy Court property. There's a sale of 6102 Goldworthy Court. What did that sell for?
$160,000.
And that Goldworthy, that's 6102 was a 1,436 square foot house that sold for $160,000, correct?
It is.
And the subject property on Goldworthy Court is 1,600 square feet.
It is.
A little high,
A little higher.
160 square feet higher.
Yes.
And it's assessed at 167,500. Does that sale support the county's value?
I believe so, yes.
Do all of these sales on this qualified sales report, do they support the county's value of 167,500?
Well, when you look at the statistics here, our median ratio for the neighborhood is 0.982 or 98.2% of market value, which is our threshold that we're trying to get to. When you look at the coefficient of dispersion for the neighborhood, it is 4.703. So both your measure of central tendency, your median, says that we are very close to 100% of market value, and your level of appraisal, your coefficient of dispersion, which is looking at how close on average each of those sales is to your median. We were 4.7% at each occurrence on average, which is right there with what the IAAO standards say that we should be.
So when you say the median is 98.2%, that means that the county's assessed value for the property that's sold is 98.2% of the actual sale price.
Yes.
And the target is to be 100%.
100%, yes.
And and is this the type of statistical testing that the county does during the revaluation process to refine its values?
On every neighborhood.
All 1,000+ neighborhoods.
Well, that's just the residential. We do this across all segments of property, looking to ensure that there's equity from residential neighborhood to residential neighborhood, that there's equity between commercial and residential properties, to ensure that high-end neighborhoods are valued at an equal level as low-end neighborhoods, trying to ensure that everybody is paying their fair share.
When you say everybody's paying their fair share, that's irregardless as to who owns the properties.
Yes, that's only, as an appraiser, I have to be unbiased. I have to be consistent. I have to follow the standards. I have to follow the statutes, and nowhere in the statutes does it tell me that I can treat one home differently than another.
There's nothing in the statute that says you should treat America Homes for Rent residential properties different from a residential property that's not owned for rental purposes.
Correct.
Now, based on the information that you've reviewed regarding 6110 Goldworthy Court, based on your review of the residential improvement report and this qualified sales report, do you have an opinion of what the true value of 6110 Goldworthy Court was as of January 1, 2019?
I do.
What is that?
It is, I believe, $167,500.
Now, let's now look at the qualified sales report, which is exhibit number 22, or Cabello Court. And a Cabello Court property with 1,682 square feet. I see, and we have it valued at $205,000. I see there's another property on Cabello Court that was a little over 100 square feet smaller, 1,570 square feet, and it sold for $203,000 in June of 2018. Is that sales thing to suggest that the county's assessed value is a market value?
It does.
And do the other sales, qualified sales on this report, do they support the county's assessed value?
Yes, they do.
Explain what the statistics on this report say.
Well, in this neighborhood, our median is actually 99%, meaning that the midpoint of the neighborhood, our assessed value is 99% of the market sales price. Our coefficient of dispersion, again, trying to look at not only that central tendency, but on average, how close are we to that target each time? We're at 3.937%, which again is well within standards expectations for neighborhoods similar to these.
Now, if the county's assessed value for this property was $168,100, as the taxpayers suggest, how would that change your statistics?
Well, it would, as far as a sale, it would not affect our qualified sales report and the statistics here. It would produce and allow inequity into the neighborhood and would show up on that improvement report that we looked at earlier.
The taxpayer's value of $168,100 is actually for this 1,682 square foot house is actually less than a 1,289 square foot house that sold for $175,000 in November 2018, correct?
Correct.
And so the taxpayer's value just does not come across. Is there anything in either the qualified sales report for the Goldworthy Court property or this qualified sales report that suggests at any point that the county's assessed values substantially exceed true value?
No, there's absolutely nothing in the reports or testimony I've heard today that leads me to believe that the values that we produced are not good, accurate estimations of market value.
In your opinion, it's a true value. What was the true value of 3319 Cavello Court as of January 1, 2019?
$205,000.
The exhibit number 25 is a excerpt from a guide to the listing, assessment, and taxation of property in North Carolina by J. Rigsby Denning. Are you familiar with this?
Yes, I am.
How are you familiar with this?
I was at the School of Government and a colleague of Shay's at that point, and actually did proofreading of the book, the manuscript for her prior to its publication.
So you helped her write the book?
No, I didn't help her write the book. I just read the book to make sure that there wasn't anything in there that I felt like was inconsistent with standards and law.
And there on page 95 is valuation of standard for real property. And then on page 96, there's something I think I have it underlined. Would you just read that into the record?
Yeah, on page 96, middle of the first full paragraph on the page, it says, the sales comparison approach, as the title indicates, compares the property being appraised with similar properties that have recently sold. This approach is most applicable when sufficient sales data are available for similar properties. It is commonly used to appraise single-family residences and land, but also is an effective approach for valuing multifamily and commercial properties where sufficient sales data for these types of property are available.
So does the county use sales data to determine assessed values for single-family residential, multifamily residential, apartments, commercial, office, and everything?
We consider it for all properties in the county.
And do you also consider income information for all properties when it's available?
When it's available, yes.
Now, with respect to the properties that are the subject of this action, is there sufficient sales data available to support the county's values?
Yeah, in both of those neighborhoods, there was sufficient sales data with good timing just prior to the revaluation for us to come up with our market value estimate.
Then the next exhibit is Exhibit 26, which is part of the Department of Revenue Appeals Manual. Read what is on page 36 about the sales comparison approach.
The sales comparison approach, first bullet under number 3, the 3 approaches to value. This method involves researching the actual recent sales of properties similar to the one being valued. The sales prices are adjusted somewhat to account for relatively minor differences between the properties, and a typical sales price is estimated for the type and location of the property in question. Because this approach is derived from actual market transactions, it is usually considered the best indicator of market value.
You agree with that?
In most cases, it is considered the best indicator.
And did the county primarily, was the county's reliance on the primary reliance on the sales comparison approach to determine the assessed values for the subject properties, was that in compliance with this document?
Yeah, it's in compliance with the Department of Revenue Manual. It's in compliance with the North Carolina General Statutes. It's in compliance with the IAAO's valuation standards. It's in compliance with USPAP.
Did the county's method of assessing these properties produce uniform appraised values consistent with actual sale prices?
It did.
Are the properties in the same tax neighborhood assessed similarly?
Yes, all properties within the neighborhood were assessed in a similar manner.
Are they assessed uniformly?
Yes, they are.
Was the county's 2019 general reappraisal conducted in compliance with all relevant standards of the Appraisal Foundation's Uniform Standards of Appraisal Practice, USPAP?
They were.
Was the county's 2019 general reappraisal conducted in compliance with all relevant standards of the International Association of Assessing Officers, IAAO?
They were.
Did the county use recognized appraisal standards in determining the assessed values of the subject properties?
It did.
Are you aware of any errors or inaccuracies in the county's determination of value?
I am not.
Are the county's values of the subject property consistent with the duly adopted schedules of values for the 2019 general reappraisal adopted by the Mecklenburg County Board of County Commissioners?
Yes, they are.
Are the county's values of the subject properties consistent with USPAP standards?
Yes, they are.
County's values consistent with IAAO standards?
Yes, they are.
Was the county's use of the county's primary reliance of the sales comparison approach in valuing the subject parcels arbitrary or illegal?
No, it was not. We considered all 3 approaches to value and determined that sales comparison is in fact the best method for valuing these neighborhoods.
Now, if the Property Tax Commission were to rule that the county should start assessing residential properties owned by commercial companies such as America Homes for Rent and being rented, if the Property Tax Commission were to tell the county, you got to start relying primarily on the income approach based on income information from the taxpayer, how would you be able to implement that on a mass appraisal basis?
It would require communication with those companies in advance of the reappraisal to gather that information, gather all their investment information, to compute those investment values.
Well, how would you apply it to a residential home that is owned by Joe Smith that just happens to be having it on the open market for rent? How would you apply that?
Based on how the ruling was written, we may have to get in touch with Mr. Smith to find out what his investment criteria are.
Any idea how many homeowners there are in Mecklenburg County, individual homeowners that actually rent out their properties?
I'm not aware of that percent, no.
Are there any procedures that would be in place or any statutory law that would allow the county to change an appraised value if a property went from a rental property on January 1, 2019 to a owner-occupied property sometime during the reval cycle?
Not currently, no.
So everybody could just say, I'm renting my property on January 1, I want a lower value, and then later start occupying it themselves.
I'd want to go buy a mall and live in it and have it valued as a house.
So do you see a lot of problems if the commission were to adopt the taxpayers' method?
Yes, I do.
And but if the legislature told you to value it the way that America Homes for Rent wants to do, what would you do?
I would follow the law.
So there is a recourse for America Homes for Rent.
Well, there's the statutory guidelines by which all assessors in North Carolina are required to value property. And I am sure that the Moose Lodge at some point had to lobby the legislature to be included in the list of exempt properties. Other types of individuals, you know, are listed in there. Historic properties have their own place. Present use value properties have their own place in the statute, and we value those at a different level based upon their statutory reference.
Now they talked about, their witnesses talked about, they're just trying to provide affordable housing. You heard that testimony?
I did, the naturally occurring affordable housing.
Right. Now, are there statutory procedures for tax breaks for low-income housing?
There are.
Do these particular, have they applied for any of those statutory breaks?
They have not.
Does it appear based on what you see that these properties would qualify for lower income housing tax breaks?
Not based on the current statutes, no.
So there is a low income housing exemption or exclusion. It just doesn't apply to America Homes for Rent's properties.
It does not.
I don't have any other questions.
All right, Mr. Shanine?
Yes, sir. Good afternoon, Mr. Joyner. It's a pleasure to see you.
Good to see you, Mr. Shaheen.
I don't think I'll take as long here because as we stipulated to, we don't have any questions on your cost approach or your sales approach. We're just going to have a good, fun conversation about principles and the law.
Okay.
So I do want to ask you to turn back to the county's exhibit number 25, if you'll may, for me. And I'm going to read to you from that same manual the following completed third approach to the underlined section. The third approach, the income approach, is generally accepted as the most reliable method for determining the market value of investment property. Would you characterize what American Homes for Rent has as investment property?
Yes, I would.
Okay. So again, following up on that, American Homes for Rent's properties in this specific instance also qualify as commercial activity, correct?
Yes, it does.
Okay. So based on your testimony, though, I just want to make sure that I have an understanding.
Okay.
Commercial activity is treated differently in all instances than ownership based on the difference between sales and income. Is your testimony today that American Homes for Rent should not be able to avail itself of the primary method of valuation for investment properties simply because they also participate in the residential home market?
My testimony today is that the neighborhoods where their properties are situated, looking at the three approaches to value, taking into consideration the definition of market value, looking at the definition of fee simple, understanding the highest and best use of the property, that those properties are best valued after considering income and cost at $167,500 on Goldwater and on Cabello at $205,000.
Okay, but in the discussions of these homes, since these were appealed on the income approach, I remember very specifically these homes, since they were appealed on the income approach, they're in neighborhoods where over 50% of the population is a renter, correct?
I don't believe I've ever been given that information.
You and I never had a conversation about making sure all of the income appeals in Mecklenburg County were in home residential neighborhoods and us providing that evidence to you at the BER of neighborhoods of over 50% of residential renters?
Larry, you and I have had a lot of conversations.
That's true. I'll drop that. Don't worry. We'll leave that one be.
For that individual conversation.
Okay, we'll leave that one be. So moving on, returning back to on the assessment potential, I want to go back to exhibit number 26, if you mind. And I'd like you to turn the page from 36, and I'm going to read from the section again, just one more time. On page 37 at the top. The income approach. Properties which generate rental income can and often should be valued based on the present value of the income stream they generate. This approach is often used for commercial properties or for residential rental properties. So is your testimony today that if there is, in your opinion, enough sales that the income approach is irrelevant?
No, that's not my testimony today.
Okay, so how should the income approach properly be applied, in your opinion, to the valuation of these homes, given that this is commercial activity?
When you are looking at each individual neighborhood, you have to determine what the majority of the buyers and sellers in those neighborhoods are most interested in. So someone who is buying a multifamily or an apartment or an office building is going to be interested in the income stream. Someone who is buying in these neighborhoods, some may be interested in the income stream, but many are interested in the actual ability to use the property and to live in the property. So we have to replicate the market with our mass appraisal model. And again, in these neighborhoods, it was our determination that the predominant valuation method, the one that we were going to put the most emphasis on, was going to be the sales comparison.
So, okay, let's turn to that, because that's a great point to get to. You and the county did an excellent job doing a commercial market study, correct?
Yes, we did.
And that commercial market study outlined all different types of properties that are operating under commercial auspices in Mecklenburg County.
Yes.
Did it divide each one by area?
It did.
Did it provide a market cap rate?
It did.
So would it be possible for the county to do the same commercial market study and add residential rentals into that study and provide a cap rate to base these rentals on at the same time that they perform the traditional commercial market study?
Absolutely.
Okay. So the method seems to be there, but the next question would lead to, given that we've talked about equity, I want to go back to equity very quickly. We have sales of properties of all types that are used, but we just read from the North Carolina Standard. We just read from the actual appeal manual that income can and should be used on investment properties and residential rental properties. So where in that report does it preclude you from primarily using the income approach upon discovery that the home is used for commercial activity?
Within that description, first, let me take a step back. When it talks about residential rental properties, there are lots of residential rental properties. There's apartment buildings. There are, you've got multifamily complex. So we can and often use the income approach on those types of properties. But within a neighborhood that we are using that income data, we do not value some using cost and some using income. We're going to use the same methodology throughout that neighborhood. So there is only one consistent way to value the properties in these neighborhoods, and that is following the statute at market value and considering the highest and best use.
So to help me understand, because I'm a little confused, I get the equity among the residential homeowners because they're all owning for home ownership. They've all got pride of ownership. They've all got, they all pay what they pay because they want to possess it. But based on, the example that Mr. Adden gave us from what American Homes for Rent does, 9 properties out of 2,400 properties, which is 0.3% of their Mecklenburg portfolio, participated on the open market. They don't buy and sell.
So Jack, that wasn't the testimony.
All right. Ask your question again, and let's leave Mr. Adden's testimony out of it.
Absolutely.
The testimony was these are sales in 2017 of their properties. We did not do a search of all American Homes for Rent purchases and sales. We limited it to the 2017, 2018 years.
Okay. But the 20, just to make sure I've got an understanding, Mr. Adden. So it's the 20, those are the sales from 2017 and 2018 that you can find.
I think for the most part, my understanding is your client buys a portfolio.
They do. That's correct. Now, so
but not all of them.
Okay, no, not at 3.3% actually, when you look at the number, but that's okay. We're going to leave that one alone. So given that they participate in commercial activity, given that they provide the same product, while it be a different structure, but the same product as apartments, hotels, any type of other income producing asset, wouldn't it be inequitable to treat them as residential owners who are not as sophisticated?
No.
No?
They chose to buy and sell in that market, and they are basing their valuations on what their investors and their real estate investment trust are looking to have as a return. You've got people most likely around the world that are investing in that real estate investment trust that have no knowledge of the Mecklenburg County market. American Homes for Rent is not being treated unfairly by being valued equitably with other properties. They could sell every one of those properties individually with a realtor and make more than what they sell these as at a portfolio valuation.
Mhm.
We value each parcel, not the portfolio.
Mhm.
So we have to consider that they could sell that home at its highest and best use.
I completely agree with you. And I'm going to draw your attention now to Exhibit 7. This is the plaintiff's Exhibit 7 on page 3, bottom right-hand corner. And I'm going to read for you from paragraph 4.
Yeah.
There you go.
Larry, hold on one second. He
Okay,
doesn't
take your time. Yeah, take your time, guys.
You're looking at your exhibit, right?
Yes, sir. Taxpayers Exhibit.
All right, let me give it to him.
Okay.
Okay, so it states here very quite clearly in Belk Broom, we are mindful, however, that while the income approach is preferential, a combination of approaches may be used because of the inherent weakness.
What
Just
page
a
are you on?
second, Mr. Shaheen, what page are you on?
On page 3, sir.
All right, when he
Okay.
gets it.
Yes, sir.
You
Okay,
have
I'm
it,
ready.
Mr.
Yes.
Joyner?
Yes, I
Okay,
do.
proceed,
Thank you.
Mr.
Sorry about that. My apologies, Mr. Joyner. We are mindful that while the income approach is preferential, a combination of approaches may be used because of the inherent weakness in each approach. We do not foreclose using such a combination of approaches here, so long as the income approach is given the greatest weight. Given that Belk v. Broom has already authorized assessors to give income the greatest weight in properties while using a combination approach, would it not be preferable to, instead of using the sales approach while not developing an income approach, to develop both approaches and use them in combination to provide for the equity to the residential homeowners while also acknowledging the presence of commercial activity?
I don't think so, no.
Okay. I got no further questions at this time.
I've got a follow-up question.
Go ahead, redirect, Mr. Adden.
Mr. Joyner, does America Homes for Rent income approach valuation that they did on Exhibit 5 and 6, does it produce true value of the subject properties?
I cannot place a full opinion on there because I do not know where they pull their market information or if there is market information. All I have heard is that this is based on our internal rates of return.
No other questions.
All right, Mr. Joyner, let me ask you a couple questions. Did the county develop, this is a new concept we have here. I don't know if it's been presented to you before or not. It's the first time, I think, before us. It seems like it's becoming more and more prevalent to purchase these homes and then use them as rental and apparently commercial activity, and they are rented. But has the county considered developing an income approach for these type of properties when there's evidence that they are rental properties and they're being used, I guess, for what's contended as a commercial purpose? Or did you just say we don't think that we don't think it's applicable because it's a residential house, even though it's a rented property?
Again, Chairman, when we were going through our neighborhoods, we're going to consider each of the approaches to value. We're going to look at cost data. And if the cost data is higher than what we're looking at as a sales comparison, and it doesn't match up with transactions in the market, we would not use the cost data. Similarly, if we find evidence of rentals and we're not able to replicate the market, trying to get back to market value, which again is going to be trying to match up those sales prices within the market, we're not going to rely on the income approach as well. If, Larry asked me about the conversation of the 50%. I don't recollect the conversation. But if there were neighborhoods that were fully rental properties and we were trying to come up with our valuation, we would not be doing an adequate job if we didn't consider the income approach. So we do consider, I would venture to say that Mecklenburg County values a higher percentage of properties using the income approach than most counties in North Carolina. We rely heavily on the income approach. But these
that's for what you consider commercial property. But what about residential properties that are rented? Do you consider those, or does it have to be the whole neighborhood? That's what I'm trying to, not that it might end up being the highest and best and the true value, but is it one that where it is rented and it's a residence that the income approach is appropriate to consider? It seems to me you're saying it's not appropriate.
Well, I think you go back to what is the definition of market value. And let's go back to the example Mr. Wheeler offered. You've got two houses side by side, same developer developed the neighborhood. They're the exact same two floor plans. They even have the same siding and the same shutter colors. The rooftop is the same. If one of those houses has Mrs. Joyner, retired school teacher, living in it, been there for 30 years, and the other one has Mr. Blackwelder, who is renting the property from American Homes. Those two houses, if placed on the market to a willing buyer, willing seller, all other things being equal, should have the same value. That's market value. The income approach is one of three approaches to value. And you cannot place an emphasis on one approach to value. As was said earlier today by Mr. Bosworth, that's where appraiser opinion and appraiser experience and their understanding of the market have to come in. And I truly believe that if we had two properties side by side, exactly the same quality, exactly the same age, we would not be meeting the letter of the law in North Carolina by placing two different values on those properties.
Let me ask you one more question. So this is apparently getting more and more prevalent. Suppose in future years, this kind of activity for these residences, single-family residences, where they're rented and they become generating higher profits, and they become, from an income approach, more valuable than from a sales approach. Is there anything that prohibits you from valuing those properties from the income approach?
If your market evidence, as you stated, shows that the highest and best use of that property is then as an income producing property, and we have market transactions that show that people are purchasing those income streams, by all means, it would be appropriate for us to value all of the homes in that neighborhood, because Mrs. Joyner may be living there, but if she were to sell her house, she would sell it to the person who was going to offer her the most money.
All right. I think that's, oh, let me ask you this. At the hearing, Board of Equalization and Review, was this information that is being presented today by the taxpayers, was that presented to the Board of Equalization and Review?
I believe it was, sir. Yes.
And they considered it?
Yes, sir.
All right, but rejected that approach in whole, or did they look at it and determine that the approach was not supportable from a standpoint of the information that they provided?
I don't know that I can answer that accurately. Right now, we can try to get information on that.
No, that's okay. That's okay. All right. Other questions, Commissioner Guest, looks like.
Mr. Joyner, thank you for your time today. I just want to recap a couple of things for my understanding. So in the county's appraisal of this property for this appeal, the county, you testified, did consider the three methods of appraisal: the cost, the sales comparison, and the income approach. Is that correct?
Yes, sir.
Okay. After evaluating the cost, the income, and the sales approach, you then felt and placed the most value on the comparable sales approach.
Yes, sir.
Okay. And that was based on the highest in use value of the properties in each residential community.
Yes, sir.
Okay. Now let me ask you a question about your schedule of values. Okay.
Okay.
So you establish a schedule of values to be able to value properties across the county. And for residential properties that are rental properties, whether they are apartment buildings, duplexes, triplexes, whatever they happen to be, does your schedule of value establish a capitalization rate that you use across the board?
It establishes capitalization rates based on areas and market areas within the county.
Okay.
So we've got different cap rates in different areas.
Okay. All right. And where do you obtain the information to establish the cap rates? Is this from a national publication? Where does this come from?
We actually hired a local MAI appraiser who did a commercial data study for Mecklenburg County, and that study was used by the office to value those types of properties and became a part of our schedule of values.
Okay, and that's so you can keep your capitalization rate in conformity and uniform across the county, and
Yes,
your capitalization rate would not vary from one property to another based on the efficiency of management or owner investor desires for a rate of return. You would use a standard rate.
We would use a market-based rate. Yes, sir.
Okay.
Standard rate.
Okay. Do you today happen to know what the capitalization rate would be that would apply to residential rental property?
I do not know offhand. No, I do
Okay.
not.
Thank you very much.
Thank you.
I have a few questions on that. Your cap rate that you talk about in the commercial data study, is it the same cap rate for every piece of property in a certain area of the county, or does it depend on what type of property it is?
Well, the cap rate's going to depend on the type of property and the location of property, because an office building and an apartment complex would have different rates of return just like an office building in Uptown would be different than one in Ballantyne or one in the university area.
So if you have a strip shopping center next to a hotel, next to an office building, you do not necessarily, your commercial data study does not apply the same cap rate for all three properties, does it?
It would not it could by chance if those cap rates were derived for each of those equal that, but no, each of those would be derived separately.
Your commercial data study, when it has cap rates, it does a cap rate for a Class A office building, a Class B office building, a Class C office building, for a motel, for a hotel, for a strip shopping center, takes into a whole lot. And it's not just, we have a cap rate of 6% in this section of the county and a cap rate of 8% in another section of the county.
Correct.
And did any taxpayer, any of these commercial, residential, rental companies who are in the business in Mecklenburg County object or request modifications to the Mecklenburg County Schedule of Values when it was had public hearings in 2018 prior to the 2019 revow?
No, in fact, there were no objections to the schedule of value during the appeal.
No further questions.
Mr. Joyner, let me, one final one. Suppose in this instance, you considered the income method for these properties, and they came up like the taxpayers contending. Obviously, you could look at them, and if you had a model for this, you could say, no, they exceed that. They're not supportable. But suppose they were from this approach, but yet the sales approach in this same neighborhood, which you seem to indicate there are sales that are not rentals, indicates that they're selling at your sales approach rate. Could you not look at both of them and say, well, yes, income method is to be considered and it generates this value, but the sales approach, which you have so many of, generates another approach? And answer that. And let me preface that by saying, isn't one of the reasons you use income approach on the commercial property is because generally there's not as many comparable sales to use. So that's one reason, maybe a primary reason, that for commercial properties they use the income approach. But here you got plenty of sales of single family residences.
That you have to look at your data collected, and you are correct. There's not always going to be enough sales of office complexes to do the sales comparison approach. But what I think is important here is we stated earlier that we object to their income approach because their income approach is not establishing market value. Theirs is an investment value. It is the value to American homes. There are sales that have taken place, and we'll talk about those later, that we believe you could come up with an income approach and that it would support our value on the sales comparison.
All right. Mr. Adden, I think we're through with that witness, so I'll call your next witness, unless I don't see any hands raised.
Okay, next I call Jeremy Blackwelder. State your name, please.
Jeremy Blackwelder.
And where are you employed?
Mecklenburg County as a senior real estate appraiser.
And how long have you been employed with the county?
Since 2014.
And you're a certified residential real estate appraiser in the state of North Carolina?
I am. I've been a real estate appraiser for about 15 years.
And prior to working with Mecklenburg County, did you also Do single-family residential appraisals as an appraiser?
Yes, that was my main focus. I started in Brunswick County, North Carolina, did a lot of the beaches mainly, east of 17.
And is your education and experience all set forth in your resume, Exhibit 6?
It is.
I would offer Mr. Blackwelder as an expert in the field of mass appraisal of real estate and an expert in the field of ad valorem appraisal of real property.
Without objection. Put
No
me to-
objection.
All right, let's just kind of go through some of these exhibits that we haven't covered, and then we'll get to some meat and potatoes here. Exhibit 6 is your resume. What is Exhibit 7? Going through the county's exhibit book.
Exhibit 7 here is the property record card, as we discussed before. It has everything from building permits to the sales that's taking place on the property, the land value, all the building attributes, size, square footage, everything like that.
And based on your information about the property, the property record card, the information regarding 6110 Goldworthy Court is accurate?
Yes.
And a lot of times in our appraisal process and in the appeal process, taxpayers have issues with the property record card, and those are issues that are readily and easily fixed, correct?
Absolutely, yeah, like a square footage issue. We may be off a foot here or there or something. We can correct that, or the siding was wrong.
But there's nothing that America Homes for Rent says is wrong about our property record card.
No.
Then Exhibit 8 is a picture of the property.
Yes.
Then Exhibit 9 is an aerial of the property.
Yes.
And it's actually 2 aerials, one a little further, but and all those houses appear to been built about the same period of time, correct?
Yes, it appears to be a homogeneous neighborhood to me.
And then Exhibit 10 is a map. This particular property is off of Independence Boulevard, I guess in Wallace Lane, is that right?
That's correct.
And Exhibit 11, that appears to be an MLS listing when the property was marketed back in 2007.
Yes, yep. Sold for $144,315, 7/07.
2007.
Yes.
And you're not saying that this listing in any way affects the value of the property in 2019, are you?
No.
But it does show that this property is capable of being sold on the open market through MLS.
Correct.
And Exhibit 12 is the residential improvement report that Mr. Joyner testified about.
Yes.
Do you have anything to add to that report?
I mean, it's our way of checking the consistency of each property within a neighborhood. We also have a landline report, but this actually gives you the landline as well. So you can go down through the land and make sure you're pretty consistent throughout the neighborhood.
All right, and Exhibit 13 is the qualified sales report that Mr. Joyner testified about that supports the county, his opinion of value.
Yes.
And Exhibit 14, what is Exhibit 14?
14 is a comparable grid that I put together based on comparable sales in the subject neighborhood, which kind of grids it out as like I would do if I was doing a fee appraisal or an individual property appraisal.
Let me stop you there. This compar appraisal is something you did for this hearing, correct?
Correct.
You don't do a compar appraisal for each property during the mass appraisal revaluation process. It's just that we do it for tax appeals to the Property Tax Commission.
Correct. Another way of checking our consistency.
And you personally did this?
I did.
Okay. And you got 3 sales, comps 1, 2, and 3. Tell us about each of these sales and why they're comparable.
Mr. Madden, let me stop you for a minute and ask this. They stipulated that the sales approach that you used was accurate. So do you think you could just let him give an opinion that that's correct and we don't have to go through all of the backup information since they're not contesting the sales approach?
Well, if Mr. Shaheen will stipulate that the county sales comparison approach value of $167,000 $500 for 6110 Goldworthy Court and $205,000 for 3319 Cavella Court is true value as defined by NCGS 105-283, then we can stop this line of questioning. If you're willing to stipulate that it's true value.
If I may, Mr. Chairman, I hate to interrupt the testimony, but I'm gonna remind Mr. Adden that I've stipulated that the sales approach was correctly done, and am contending that the true value in money lies somewhere below that due to the sales approach being the cap of the top value, and that failure to consider the income approach by a development of an income approach should result in a reduction in value. So I'm happy to stipulate that the sales approach, as I've said, is correctly done, and that the value they resulted in from that sales approach was a correct sales approach number. However, because we're contending of a difference in value based on a failure to review and correctly perform an income analysis, I cannot stipulate to what he likes because there's no reason for us to be here otherwise. So like I said,
I understand.
I hope that, yeah.
I understand. Mr. Adden.
I won't be that long, Your Honor, but I do need to build a record.
Okay, well, that's fine.
Just take us through this exhibit 4, this exhibit, if you will.
So this is 3 comps within the subject neighborhood. The first one here is on Goldworthy Court, right next to the subject. You can see there's minimal adjustments there. That was my number 1 weighted comp.
And it sold when for how much?
It sold October 2018, or October 12th, 2018 for $160,000.
And that's just 2.5 months prior to the rebound date.
That is correct.
And how many square feet is it compared to the subject?
It's 1436 versus 1600.
So you make some adjustments because of the size?
Yes.
And you also make some adjustments because of the date of the sale date?
The sale date, and it looks like there the garage was a little smaller, so we made a positive adjustment there.
And then you can, and your adjusted value would be $169,947 for this property at 6102 Goldworthy Court.
Yes, $169,947 would be the adjusted price.
And is that a pretty good comp? You feel that's a good comp?
I feel that's probably the best comp in this neighborhood.
And the other 2 comps, you want to go over them briefly?
Yep. So comp 2 sold November 29th, 2018 for $179,000. We did adjust it a small amount for time there, $809. The size was pretty close, 1656 versus 1600. So we did a minus 2520. And then the garage, it looks like it was a little smaller too. So there's a small $400. The adjusted price is $177,721. Comp 3 sold August 3rd, 2018 for $187. It's in the subject neighborhood. 1404, the adjustment for time, let's go down, and then the size, there was an adjustment there for the about 200 square foot of size. And then the garage was, yes, a small number of $216,000 because it's a little bit smaller than the subject's garage. The adjusted price here is $199,904.
Okay, based upon your work on this particular property, do you have an opinion as an expert in real estate appraisals, what the true value of 6110 Goldworthy Court was on January 1, 2019?
Based on this report and this report alone, we would, if you look up in the left-hand top corner there, there's a grid estimate, and that's based on a moving average. So it's going to give the most weight to 1, 2, and 3 in that order, and the value would be $179,400.
So in your opinion, does the county's assessed value $167,500, does that substantially exceed true value?
No, it does not.
Now, the next exhibit is exhibit 15 that's a copy of the BER hearing decision for this property.
Yes.
Now, Mr. Shaheen you were here and listened to the taxpayers' income approach using their Exhibit 5 for this particular property. And there were issues that Mr. Joyner talked about the cap rate. It's not a market rate. Not so sure about some of the factors being a market rate. You recall that testimony?
I do.
Do you have those same types of issues with their Exhibit 5?
I do.
Now, let me ask you, now, how many years did you do appraisals of single-family residential homes?
I've been licensed or certified since 2009, and before that, you work as a trainee. So I worked from 2006 to 2009 as a trainee.
Now, the uniform residential appraisal report form that I talked with Mr. Bosworth about, does that have a provision on that? You familiar with that form?
I am.
Does that form have a provision for the income approach?
Well, that approach is based on a GRM, a gross rent multiplier. So you would take 1 month's rent and you would go into the market and do a study of, you would find similar sales, and if you can, the same properties that are rented to come up with the GRM, which would be based out of the market.
Let me stop you there. Is the gross rent multiplier approach to value an income approach value?
It is.
And that gross rent multiplier approach, income approach value, is the approach that is used by appraisers of single-family residential homes when they are making reports to lenders, banks, mortgage companies.
Yes, that's correct.
And you did that throughout your experience as an appraiser.
I have.
You get your sales information with your grid, but you also have cost information, and then you have income information.
Right.
Now, have you done a gross rent multiplier income approach study for 6110 Goldworthy Court?
I have. I was kind of intrigued by it, and I actually did that over lunch.
Over lunch today?
Yes.
And
Hold on one sec. We're going to object. Defense petitioner has not been furnished that exhibit. And
I don't have an exhibit. I don't have an exhibit.
Well,
He's going to testify about what he did.
it is new. It certainly could be relevant.
I'm
Mr.
gonna,
Adden, it would have been good if you were going to do this, if you would have given that to Mr. Shaheen when we started up, so he would have had a chance to look at it.
Mr. Blackwelder's gross rent multiplier income approach has got to support the county's value.
and that's fine, except for the fact that I have no way to verify where that
Well,
information came
let's,
from.
all right, let's not talk over each other. Our court reporter, commission reporter has trouble when that happens. So I've heard your objection, Mr. Shaheen. Now, Mr. Adden, you can reply to his objection for our rule.
The issue is, they have an income approach that they use that isn't based on market values. And Mr. Blackwelder did a gross rent multiplier income approach, which is commonly used by real estate appraisers for residential properties, and did that. And he should be able to testify as to the results of that. We don't have any exhibits. He's going to testify about the results of what he's found.
I'm gonna.
And that is based on market data, based on resident properties that were sold in 2018 that have been rented. And the taxpayer could have done a gross rent multiplier study and produced it, but they didn't. So we're talking about another income approach value, where you take a property, a house that it was sold in 2018, you take, and it was rented based on the document, that it was a rented house. You take the rent and apply it with the sale price to determine a multiplier. And then from that multiplier, you apply it to the rents for these subject properties to get to an assessed value. It's an appraisal method, a common appraisal method. And in fact, it's the appraisal method used for single-family residential homes when you're appraising for banks and lending institutions.
All right, I'm going to allow the testimony, but Mr. Adden, I think if you're going to do something like this in the future, you need to make it an exhibit so the taxpayer has a chance to review it. Mr. Shaheen, I'll be liberal in letting you cross-examine him about
Thank
it.
Mr.
ahead.
Blackwell, just tell us what you did with respect to 6110 Goldworthy Court and the gross rent multiplier income approach.
So I gathered on this property here, there were 4 sales that I found, whether they were in the neighborhood or right there nearby the neighborhood, similar to the subject. And I saw that they were sold in between 2017 and 18, and they were rented between 2017 and 18. I arrived at a multiplier from that. I gave each one a weighting based on what I think should be the highest weight, and there so on. This is Goldworthy Court, 6110 Goldworthy Court. I came up with a weighted GRM of 136. If you take 136.76 was the actual. If you take 15,360, which is their yearly rents, divide that by 12, come up with 1280 per month, times 1280 by this GRM of 136.76, you come up with a value of $174.80.
So your gross rent multiplier is the rent. You base it based on rents from properties that are sold in the years prior to the reval to get a multiplier number that you said was how much? 132?
136.76.
And so that's a market multiplier, correct?
Yes, I derived that from the market sales, whether they were in the neighborhood or right there nearby the neighborhood, of sales and rents that took place in that market.
And then you applied it to the monthly rent for Goldworthy Court, which was $1,580 a month. $1,280 a month.
Yes.
And that comes up with the value of 174.
Yes.
And is that an acceptable USPAP method of appraisal for income approach method of appraisal?
Yes.
And that's actually it's a very simple form on the appraisal report form, correct?
It is. It's just the multiplication. Excuse me.
And in fact, your income approach value using the gross rent multiplier of $174,000 is pretty close to what America Homes for Rent income approach value would be if they used a 5% cap rate as on their Exhibit 10, as Mr. Wood testified today, correct?
That is correct, along with all the other valuations, the sales, cost, and income. And like Bosworth said earlier, I mean, typically when you do an income approach, I mean, they're all should be tied together, being close in value.
So your use of the gross rent multiplier approach based on sales of properties in the area where this Goldworthy Court property is produces an income value that is very close to or tight with the county's sales comparison approach value.
That is correct.
And you did that approach using acceptable appraisal standards.
I did.
Now let's go on to Cabello Court. Let's go to the next exhibit, which is exhibit number 16.
Mr. Chairman, I'm going to renew my objection for the
All right.
record on this one as well.
Sure, your objection is noted, and for the same reasoning, I'm going to allow it to, and also it's partial in rebuttal to some of the other testimony that we previously heard.
Okay.
All right, and when we finish with this witness, we're going to take a break, and that Mr. Sheehan will give you a chance to get
I would like Mr. Blackwelder to put that gross rent multiplier on paper and send it to me before his cross-examination.
All right, yes, I think that's reasonable. So if you can have that done, Mr. Shaheen, and then we'll make sure he gets it, and then we'll convene back for his cross-examination when we have after a break.
You got your notes on a couple of pages there. You can we'll be glad to copy those notes and send them to him. Yes.
Okay, good.
Okay, let's just finish up. Let's just go through the county's exhibits. Exhibit 16 is the property record card for the 3319 Cabello Court, correct? Excuse me.
We're on
16.
16. Yes,
And there are no issues brought by the taxpayer about the specific information for that property, are there?
no, sir.
And 17 is the actual picture of the subject property.
That is correct.
And again, 18 are aerial photos showing it's in a fairly homogeneous neighborhood, correct?
Correct.
And 19 shows that this neighborhood is off Beard Road and Ridge Road. That's kind of the northern section of the county, correct?
Yes.
And this particular property, exhibit 20 there's an MLS that appears to have its rental price, correct?
Yes, it's the rental price back in 2013.
And then the next page of the exhibit number 20 is an MLS listing showing that the property was listed with MLS when it sold in 2013, correct?
Yes, it's sold on the open market as an individual sale.
And then property number 21 is the residential improvement report that Mr. Joyner testified about. You don't have any issues with that?
No, just a way of checking our consistency throughout the neighborhood.
And exhibit number 22 is a qualified sales report that Mr. Joyner testified about.
Yes.
And exhibit 23, explain what it is.
Okay, this is another comfort grid for Cabello Court. Let's see.
This one has 4 columns, right?
Yeah, 4 comparables on this one. I mean, without going through each one of them, if you want me to, I can, but there's 3 comps there. Adjusted weight or adjusted values are at the bottom. The grid estimate for all 4 sales is a weighted 1, 2, 3, 4, and it comes out at 2099.
As an expert in the field of residential, real estate appraisal, do you have an opinion of the true value of 3319 Cabello Court as of January 1, 2019?
Yes, based on this report, we're at 2099.
And does the county's assessed value of 205,000 substantially exceed the exceed true value?
No, it does not.
Exhibit 24 is the BER decision for this property.
Yes.
Now, did you do a gross rent multiplier for the Cabello Court property?
I did.
Tell us about that.
Okay, so this property here, from their information, is rented yearly at $19,083.54, which is, if you break that down monthly, it's $1,590.25. Based on 2017-18 sales in that market area of the subject of Cabello Court. Let's see, 1, 2, 3, 4. I had 5 different properties that were, one was a sale and a resale, so really 4 properties, but I used 2 based on the 2 different sales, and came up with the gross rate multipliers, weighted them in the way I thought they should be weighted based on the similarities. Came up with a gross rent multiplier on this particular one for 126.68. If you apply that times the $1,590 per month rent, you come up to 201,452.87.
The county, so your gross rent multiplier income approach valuation is $201,000, and the county's sales comparison approach valuation is $205,000.
That's correct.
So, and your income approach valuation is fairly tight with the county's sales comparison approach.
Yes, sir.
And with the data that you use is market data as opposed to investor data.
Yes, these were open market sales on the MLS that I came up with each gross rent multiplier and then gave them a weighted average.
Just one moment, please. No further questions.
Okay, Mr. Shaheen, we're going to give you a chance to review the information they sent to you. It's, looks like 308. We need to finish this case this afternoon. Let's, you think you could be ready in 15 minutes, or do you need to go to
It's
3:30?
going to depend on when the county gets me that information.
All right. How long is that
I
going to
have to say this is highly irregular. It's highly irregular.
I've already ruled on it, Mr. Shaheen.
Mhm.
Mr. Adden, how long is it going to take you to fax that to him or email it to him?
We're gonna. Yeah, just copy, it's 4 pages, copy the 4 pages and email it to him.
Well, these are just different notes. It's really just here.
The calculations are all on 2 pages.
Right,
Mr. Chairman,
2 pages.
Yes, Vice Chairman Wheeler.
do we need to see it?
I would hope y'all would, yes.
Of course. Good point. Mr. Adden, you're going to need to send it to Steve. Does it need to come to you or Alexandra to get so we can see it?
I'm gonna scan it to myself and then.
Yeah,
Yeah,
we're gonna scan it,
If it comes to me, then I'll send it out to you.
Okay.
Okay,
Mr.
so we
Adden,
can
send it
scan it.
also to Mr. Pelfrey. Okay.
Yeah.
Let's just go
My
ahead and
cross-examination won't be long, Mr. Chairman. I believe we'll be able to finish that cross-examination rather quickly, and then we should be done by 5.
all right. We'll go ahead and we'll adjourn till 3:30, and that'll give us a chance to review it as well as with you.
I mean, I'm going to have to recall. I'm going to have to recall my appraiser. I'm going to have to.
I understand that you may have to as rebuttal. That's fine. You can determine that during this break as to what you need to do. All right. We will stand in recess until 3:30.
Thank you.
I don't think I see Mr. Adden and Mr. Blackwelder yet.
He did the video with Mr. Blackwelder.
Oh, okay, there you are. Okay, thank you, Mr. Blackwelder. So you're, yeah, I see your hand there now. Let me ask Mr. Blackwelder, I've consulted our legal counsel during the break. I need to ask you a couple questions. The information that's on your sheets that you sent to Mr. Shaheen and to Mr. Pelfrey that was forwarded to each of us, was your information when you made those compilations, was all of that information from in the record that had been submitted, or was any of it you had to do go to some place to compile to complete your analysis?
Yeah, absolutely. I mean, I had to go into the market because that's where that came from. The MLS, the market where those type of sales took place. I mean, it's market data, not computed.
All right. So you had to pull that from independent resources. Mr. Pelfrey, can you advise us on this and whether or not you think I should rule as to it being admissible or not?
Mr. Chairman, I believe that if Mr. Blackwelder is performing calculations on information that is already in evidence, I think that would be fine. But if what has happened is additional documentation, additional evidence has been gathered and calculations performed on that, I think that the appellant is entitled to receive that information in the 10-day by the 10-day deadline for exchanging exhibits. My opinion is that, again, without knowing whether or not that information came from within the exhibits, I can't tell you for sure one way or the other, but if it did not, then I think that's something the county should have provided in advance.
If I may,
just a minute. I'm asking the council and now asking Mr. Blackwelder. Mr. Blackwelder, I understood you to say you had to go to other sources to get some of the information. Is that correct?
Yeah, the market rents and everything came from the information they submitted, but the actual data from the GRM, it came from market data around the subject property.
But was it in the exhibits that had been previously provided?
No, because they didn't support any market evidence.
All right, I'm going to exclude that since it wasn't provided ahead of time.
Thank you, Mr. Chairman.
Okay, Mr. I guess Mr. Adden, is it still your witness, Mr. Blackwelder?
I've finished my test, my direct examination. He's ready for cross.
Okay, Mr. Shaheen, and that those documents have been excluded and that testimony has been excluded, so you don't need to go into that.
Excellent. Thank you, sir. I'll put this to the side. Mr. Blackwelder, very quickly, you had said what year were you licensed as an appraiser?
2009 is when I was.
2009. So you did practice in private practice.
Excuse me?
You practiced in private practice before moving to governmental work?
Yes.
Okay. And have you performed any appraisals on income producing properties that were residential at that time?
Which time?
In your private practice, you performed appraisals on residential properties that were income producing, correct?
Yes, I worked down in Brunswick County, so a lot of it was income producing.
Right. So in those appraisals, you included and utilized and applied the income approach on those rents, correct?
Yes, on the price, correct.
Okay. So in our hearing before the BER, did you provide or give in any way an analysis of the income approach of these properties?
Object.
I was.
Object.
Well, that's admissible if he knows.
Well, we're talking. This is a de novo hearing. This is not. We don't get into what was not done at the BER.
Well,
I can rephrase. I can rephrase. I can rephrase.
Go ahead and rephrase it.
Mr. Blackwelder, at any time before this hearing, up until today, had you developed an income approach for these properties?
No,
At any time, did you do research on market data for these properties
yes,
before today
before today, no,
on the income?
not on these properties.
No. So your testimony today includes only the sales approach and does not include any relevant data as to the income approach for these properties, correct?
I completed the sales approach. It's kind of the market, the comper that was shown, the grid. I completed that. So that's a market-based approach. They're all market-based approaches.
I don't disagree with you there, but I'm asking about the market data for income approaches. You didn't include any income market data from the income approaches in your analysis of the property value.
Correct.
Okay. So if it was appropriate for you to do that in your private practice as an appraiser, why would you think it's not appropriate to do that in your job as an assessor?
I mean, we've considered the approach to value here.
But you have not developed any data or done any analysis?
Not on this particular property, no.
Okay. I have no more questions.
Okay, Mr. Adden.
In your opinion,
Across, I mean, redirect, I'm sorry.
in your opinion, as an appraiser, did the sales comparison approach, was there sufficient sales comparison approach data to support the county's value
Yes,
without getting into the income approach value?
absolutely.
And did the taxpayer prior to the BER hearing provide the income approach information that it provided exhibits 5 and 6 to the county?
To my knowledge, I'm not sure on that.
Okay. If the taxpayer provided the income information to the county at the appeal process, would the county review that and take it into consideration?
Yes, we would definitely consider that information.
And if the taxpayer presented that to the BER, is it your experience with the BER that they would take that into consider that information?
Absolutely.
Was there anything that precluded the taxpayer from presenting income information to the county or to the BER?
No.
No further questions.
All right. Any recross, Mr. Shaheen?
No, sir. I'm completed.
All right, Mr. Adden, any more witnesses?
Yeah. The county just offers into evidence is exhibits 1 through 26, and that concludes the county's testimony evidence.
Okay, we'll consider all the evidence. All the exhibits have been admitted with the exception of the one recently. It wasn't an exhibit, but it was tendered and that was rejected. All right, let's see if we got questions. I assume, Mr. Shaheen, now you don't have to put any of your witnesses back on.
No, sir. I'm completed.
Okay.
I can rest.
Okay, and the county's rest and all exhibits are admitted. Let me ask a question before you get into your closing arguments. And I guess it was just brought up by the question of Mr. Adden. What did the taxpayer present this income information at the Board of Equalization and Review, and was it considered?
I believe so, but I'll defer to Mr. Shaheen on
It
that.
was. Now I'm gonna take issue with the word considered, but it was presented and reviewed.
Okay, and you can address that in your arguments.
Yes,
So
sir.
I just wanted that to be clarified. Okay, Mr. Shaheen.
Yes, sir. Thank you. Again, very grateful for the opportunity to appear before the commission today. Gosh, this went a lot longer than I thought it would, and I can't thank you all enough for your service and what you do. This is an incredible opportunity for taxpayers to be able to come before this board to get justice. And that's what we're here today to try to achieve, justice and equality. Now, we've heard a lot of testimony today about true value. Well, what is true value? Well, the statute defines true value very specifically, and you have to take a willing buyer and a willing seller. Given that American Homes for Rent is a corporate entity and does not participate in the open market as a similar residential homeowner, to group them into a residential homeowner provides inequity. because it does not allow for the ability to review and consider properly the income approach. We've heard a lot of testimony today from Ken Joyner, and I want to take a minute and I want to thank Ken Joyner for everything as he has ever done. I think Ken Joyner is a fantastic assessor. And you know what? I hope Mecklenburg County keeps him for years and years and years and years and years. We just happen to have a simple disagreement here. And the disagreement here is over whether or not commercial activity should be considered primarily based on the income approach. Now, the county has provided all kinds of evidence on the sales approach, and we didn't feel it would be worth this commission's time to have the conversation about their approach, because it was Ken Joyner's team and they did it right. But here's where the question, the crux of this debate is going to be laid. You've seen case law from Belk. You've seen the North Carolina review on how to appeal and deal with these types of cases. You've seen the appraisal standard manual for North Carolina. Over and over and over again, investment property is to be based on the value of money it brings in and the income approach. Now, I'm certain Mr. Adden's going to again bring up the concept of, well, you've got one house here and one house here, and they need to be valued the same. Well, I'm going to take issue with that. If you have a commercial property here and a commercial property here, and one is owned by a business and one is owned on the income approach, you're gonna value it differently. I do not believe there is any inequity in that at all. And furthermore, to not allow a corporate entity to have its revenue further analyzed and considered to be able to determine the proper level of taxation based on that income, I think itself is inequity. And it's something that cannot stand. The county would contend that there's nothing in statute or case law that allows this to happen. Well, we've heard differently, not just from an expert on appraisals, but we've also gone through evidence and exhibits and testimony that these value assets are to be valued based on the income of the money with which they are brought in. And for the fact that Mr. Adden's key exhibit, Exhibit 5, which he uses to say, oh, American Homes 4 Rent purchases or sells at a different value, that's 9 homes out of an estimated portfolio of 2,400. That is 0.3%. That is not significant enough to change the way in which these properties are valued. But most importantly is the law. The presumption on this case shifts once we have presented competent evidence of value. We have had American Homes 4 Rent present its income approach. Mr. Adden has continued to say this is investment, investment, investment. You heard directly from Mr. Brown that these values, the cap rates, all come from market analysis. You heard from him that these values are in the market, their market. You've heard the rents are adjusted to account for a full year, even if they don't actually receive that. They have met every possible burden in showing that they have provided as accurate as possible an income approach. Now the county. The county in this specific instance did not provide an income approach. It did not prepare in its schedule of values a residential rental approach, and as such could not properly balance the home ownership of an individual grouping and the renters and the rental income that comes from it. We are happy to take the example from Belk Broom that a combination of approaches must be considered. But again, the primary factor should be based on the commercial revenue stream, because that's how it's done for all other businesses that are investments. And while I understand the county's concern with this, you heard Mr. Joyner say, commercial market studies have been done and can be done to provide the necessary information to rebut the evidence coming from companies like American Homes 4 Rent. And with the prevalence of this and the continued issue of this, there is nothing that says in neighborhoods like many where renters predominate, where the values may not be higher. The values may wind up ultimately being in the county's favor. So why would we preclude from this a methodology that may or may not result in the true value of money being actually accurately gotten to? Now, I understand this is an issue of first impression, and I'm very grateful for this opportunity. And we're all everyone here has the best interest of North Carolina at heart. And we've got some businesses here who are coming to this board to discuss exactly how their business model is structured and the way in which they operate. And they are more than happy to submit to any and all necessary questions from the assessor moving forward. We've had success in the income approach across the state. We have. But we need to make sure that there's a uniform standard across the state. And we're not asking for the properties to be completely lower. In fact, we're willing to work with the assessor's office to come to a compromise number. But that number must reflect the market data of the income and the market data of the sales. And similarly in case law, as we've looked at, we must use the sales approach as a cap because of the unsophistication of buyers and sellers in that market, and drill down to the accurate information to make sure that institutional investors who are actually practicing and using revenue are going to be able to be treated the same as apartments, as hotels, as other investors in this state. It's just as simple as that. Thank you.
All right. Thank you, Mr. Shaheen. Mr. Adden?
We're not here to value apartments or hotels or office buildings. We entered into a pretrial order. Pretrial order says, paragraph 3, in addition to the other stipulations contained herein, the parties hereto stipulate and agree with respect to the following undisputed facts. Paragraph A, this case involves 2 single-family residences, period. We're here to determine the value of 2 single-family residences. Mr. Shaheen stipulated to that in the pretrial order. He argues about, raises that this is an issue of first impression. I would submit to you that what he's asking is for the Property Tax Commission to make a legislative change, a change that should be done by the legislature, change that should be done by maybe the Department of Revenue. The legislature has determined that there's certain properties in North Carolina that get special tax treatment. Historic properties are excluded. That's part of the values excluded. Present use values properties are excluded. Some agricultural values get exclusions. Elderly people get exclusions. Low income people get exclusions. Low income housing gets some exclusions. If they want exclusion for residential property that is rented by corporate taxpayers, they are free to go to the legislature and get the legislature to make that exclusion so that that exclusion can be uniformly applied throughout the state. The legislature has not chosen to give them special tax treatment. And for the Property Tax Commission's job, and I've heard it from Chairman Hunter many times, your job is to apply the statutes as written. Apply the statutes as written. And 105-283 says all property, real and personal, shall be, as far as practical, be appraised or valued at its true value in money. It doesn't say you get that a house gets one value if it's owned by America Homes for Rent and another value if it's owned by Joe Smith. Then who owns it does not apply. The county does not value a portfolio. That's another fatal flaw. They want the Property Tax Commission to value this as investment property, as a portfolio, just like a bank will sell a bunch of mortgages from one to another bank. We don't value mortgages based on a portfolio value. What is at issue here are 2 single-family residences. Now, I mentioned earlier, I won't go into a lot of detail, but it is a true fatal flaw that they have absolutely no evidence of what the true value of these properties are. The true value is what the standard is. And they have to prove under the AMP case that the county's that they have to prove by competent, material, and substantial evidence
that the county's assessed value substantially exceeds true value. Now, the assessed value is presumptively correct. You've heard the testimony about the sales. You've heard how we're equitable with all the other properties. These sales support our values completely. They did not bring an appraiser to come in to testify about true value, because if Mr. Bosworth had testified about true value, he would have to use the sales approach, the income approach, and the cost approach. And I guarantee, I bet you he would be testifying that these sales produce true value, and his value would probably sustain the county's value. But instead, what they want the commission to do is accept our value. We have an income approach method where we have gross rents, we have a vacancy, we have expenses. Now, granted, as Commissioner Guest pointed out, that those are not market numbers, they're primarily their numbers. But what really is crucial is their cap rate. There is no information regarding their cap rate, that the 7% that they use is a market cap. If they had a market rate cap rate study done and that cap rate is 5%, guess what? Their value is the same as the county's value. The point is that they can't, the testimony from Mr. Wood was the cap rates are investor driven. And the statutes, the case law, everything, we don't value based on what the investor wants. It's a market cap rate. And if you applied a market cap rate of 5% and loaded for taxes, the income approach gets exactly to what the county's value is. So my point is that they're arguing about, oh, the county didn't use an income approach. The county didn't use an income approach. It needs to use our income approach. But they did not have any market data to support their income approach. If they had come in here with market data supporting their income approach, my guess is that their value wouldn't be $132,000 for Goldworthy Court, and it wouldn't be $168,000 for the Cabela. If they had market data, the NOI would be different, the cap rate would be different. So they're asking you to base the value of these two single-family residential homes on non-market data. And the Machinery Act compels the assessors to assess property based on equity, based on uniformity. And that is exactly what the county has done in this case. The county's method of operation. Mr. Joyner testified about how the county considers all three approaches to value. And for these properties, it's not in dispute. We all agree the county primarily relied on the sales comparison approach. And the literature, the IAAO standard, the School of Government, the Department of Revenue says sales comparison approach is the best indicator of market value. It doesn't matter whether it's commercial property or if it is residential property. It is the best indicator of market value. And again, they have no evidence at all of what is market value of this property. The uniformity of assessment, again, it just, if I'm a taxpayer and America Homes for Rent owns a house exactly like mine, and their taxes are 20% less than mine simply because they are renting it, that's not uniform. That's not equity. But again, the county's method produced true value. It did produce, they don't argue that. He isn't stipulating to that, but he had no cross-examination about the county's comps, the county's qualified sales report, the residential improvement report, no cross-examination about any of that, because it all supported the county's value. For the taxpayer to prevail here, the commission must determine that the county's use of the sales comparison approach, which produced true value, market value based on qualified sales, that approach was illegal or arbitrary. That's not the case. You also have to find that the county's value substantially exceeds true value or market value. How can the commission have a finding of fact or a conclusion of law that the county's values of 167,500 for Goldworthy Court substantially exceeds true value in light of the sales that are on the qualified sales report that are on Mr. Blackwelder's comp grid? You can't do that because that is uncontroverted, undisputed evidence that the county's values did in fact produce true value. He won't stipulate to that, and I don't blame him for not stipulating, but he did not ask any questions. None of the commissioners asked any questions of the county's witnesses about, well, what about this sale or what about that sale? We've been before the commission before. We all have grilled the county's witnesses about our comps. Are our comps really good comps? Are they valid comps? What about these comps? Did we make proper adjustments? There was absolutely no question from anybody saying the county's comps are bad. Why? Our comps are good. They're great comps. These are cookie cutter neighborhoods, all the houses built by the same builders at the same time, the same grades, the same actual year built, effective year built for the most part, the same land values. And for us to start saying, county, you got to start valuing residential properties different because America Homes for Rent has a income approach that they use to value property, not market values, but that they use, is just wrong. It is, you should not, the Property Tax Commission should not rule in their favor because it is, the Property Tax Commission should not be changing the state statutes 105-283 on true value. Thank you.
Okay, thank you, Mr. Shaheen, Mr. Adden. Good job in presenting your respective client's position in this novel case that we have before us. So we are going to go into executive session to deliberate now. I don't see any commissioners raising their hands for questions. So Ms. Bendette, if you can put us into executive session, and then we will try to come up with a resolution of this matter.
All right, we are all set.
Okay, I think everyone is back. Okay, after reviewing the exhibits and the testimony and excellent arguments of the witnesses and the counsels, the commission has decided this matter unanimously that we will uphold the county's value, as we do not think that it determines an arbitrary or an illegal value of the two properties involved. And we will try to have an opinion out hopefully in 60 days. That'll give your reasoning on that.
If I may, Mr. Chairman?
Yes, Mr. Sheen.
Will there be a result reached as to the second question for review as to the primary method for valuation on residential rental homes?
We'll try to address each issue as to why the county's method we thought was sufficient. So okay. We expect to address that as well in the opinion. All right.
Thank you.
Thank y'all, Mr. Brown and Mr. Wood. Y'all got up early this morning, so we appreciate that. And I think Mr. Bosworth may be off. He's local, so he's on our time. been a beautiful day around here, windy, but nice April day. We could use an April shower, kind of dry. All right, let's see, we got one more
Thank you.
matter. Y'all are free to go. We got,
Thank you.
let's see, we got one more matter from, but you don't have to stay, Mr. Adden. It is from Mecklenburg County. It's a matter of no AV 14 or AV 63 and Sunrise Hotel LLC 21 Property Tax Commission 0071. So we don't need you for that unless you want to stay.
No, thank you, and we'll see you next month.
All right. We haven't seen the agenda yet. I guess you have. But
I have. I told Johnny Petro, y'all are killing me. You're killing me.
well, by being how many parcels you got down there? 300,000 or whatever it is. And
370,000. We actually, I know y'all keep count different from me. We had 750 parcels on appeal.
that's what I was going to ask you. 750.
But 750 parcels on appeal. But some of them are multiple parcel, like this case was 2 and all. And I counted out that I have sent settlement agreements to y'all since 55 settlement agreements since January 1st. We really got it cranked up, going pretty good.
Well, and a bunch of them are sitting right here for me to look at.
Yeah.
tomorrow.
I figured that I'll be getting them, and also, but we've been working with the other attorneys that are representing taxpayers and working with the pro se people and getting a lot resolved and making. I think we're down from 750 down below 550 at least. So
okay.
Anyway, but we're getting there.
All right. Well, thank you. All right. The Sunrise Hotel LLC 21 Property Tax Commission 0071. Mr. Pelfrey.
Thank you, Mr. Chairman. In this matter, the appellant filed a notice of appeal with the Property Tax Commission on January 21st, 2021. On January 27th, 2021, our office sent a letter acknowledging that notice of appeal and included with the letter a copy of Form AV 63, along with the instruction to file that document within 30 days of filing the notice of appeal, which again was January 21 of 2021, or that the appeal may be subject to a dismissal. We did not receive a Form AV 63 or further information from the appellant, and by letter dated March 30th, 2021, the parties were notified of today's hearing to consider dismissing the appeal for failing to file Form AV 63.
All right, and we've seen or heard from no indication that anybody that was here on behalf of Sunrise Hotel. So do I have a motion?
So move.
Have a motion from Vice Chairman Wheeler, seconded by Commissioner Guest, as that we dismiss Sunrise Hotel LLC 21 Property Tax Commission 0071 for failure to file the necessary forms to perfect their appeal. Hearing no further discussion or seeing no hands raised, all in favor of the motion say aye. Aye.
Aye.
And opposed nay, and the ayes have it, and so that's unanimous. All right, Alex, we get you out of here in time, and I think I'm getting notes that our neighbors are wanting to go out to get something to eat. So I think I don't know if I'll have the beer when I get out there or the beer before I get out there. I get a dry mouth sitting here and I'm drinking water. I had coffee this morning and then I switched to this water. I didn't go outside today because I knew if I went outside, that pollen is really bad. There's all kinds of stuff blowing out there. Thank you all for your participation. Y'all are great.
Is Alexandra with us tomorrow?
I don't believe she is. Didn't she say she was not going to be here? Are you gone tomorrow?
Tomorrow. I just will be off on Friday, which is normally when.
Okay. Oh, great.
Okay.
Well,
So we'll see you tomorrow. Okay.
Yes.
We'll get to
Very good. We
And we
all,
still
everybody
have-
have a great
Do some
evening.
remarks.
We
All right.
still have 2 things for tomorrow. I mean, I just wanted to confirm that you needed me tomorrow still.
Yeah, we do. There's two,
Okay.
1 or 2 things on that require you. There's no full hearing, so you shouldn't be here long. We are going to
Okay.
deliberate possibly on another matter. I don't know if it'll require
Okay.
going back into public session or not.
All right, thank you. See
Okay.
you tomorrow.
See you. Bye-bye.
Thanks. Bye now.
Thank you.
Bye, everyone.